beginning of a real weakening that we're going to see in the labor market. Last week's climate and initial jobless claims was a harbinger of a greater degree of weakening under the hood. Do you see that?
No, I think, again, that goes back to my comment about this economy being prodded a little bit. This is a normal economy. You're not going to make straight A's every quarter. You're going to have some weakness here and there. There's going to be weakness in pockets, but that doesn't mean that it's a persistent diffusion. What we're trying to figure out, and it's a hair-trigger decision, is when the Fed can feel comfortable cutting rates. That doesn't mean the economy is bad because they start cutting it. Doesn't mean it's necessarily good because they start cutting it. I think what it means is that the Fed as a whole, collectively, feels that they're a little more restrictive than they want to be in this particular normalizing economy.
So feeling better about the vibe session, maybe. But okay, one of this idea, again, not to harp on this, but this idea of all of a sudden everybody's feeling a lot worse and the middle income consumer too. Jim Bianco, in looking at that UMich data, basically looked at it and said, there's been something strange happening with it. It's actually Democratic opinion that has really turned. I wonder if you look at it and say the same thing, maybe what's actually happening is that political bias, but it's this huge cohort saying maybe Trump is going to be elected. So it's still that political influence, but on the other side too.
It's hard to tell at this stage. We know that that Mish survey has had a methodological change too. It's gone online. We don't know if that changed the sample. We've seen, though, for the past 2 months, pretty downbeat sentiment. I'd be hesitant, though, given the changes that we've seen on the methodological end, to put too much on the political differences right now. But we know that politics does affect opinion, does affect vibes on the economy, and we'll see and should track how that plays out over the course of the next 6 months for sure.
Mila Richardson of ADP and a Bloomberg Television contributor, thank you so much for being with us, as always. Looking forward to next time. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with our own Yahaira Hackes. Yahaira.
Hi, Lisa. The Israeli military is beginning daily combat pauses along a key route in Gaza to increase the delivery of aid. The pauses run from 8 a.m. to 7 p.m. along the route and will be in effect until further notice. The army saying the moves are being coordinated with the UN and other agencies as humanitarian aid has faced major delays since the invasion of Rafah began in May. Deliveries have failed to reach their destination as they are sometimes intercepted by desperate crowds or seized by Hamas fighters. Bill Gates saying he's ready to throw billions of dollars into a next-generation nuclear power plant project in Wyoming to meet growing U.S. electricity needs. The billionaire telling CBS's Face the Nation that his energy company, TerraPower, relies on sodium cooling rather than water, which is believed to both simplify the process while also making it safer and could make nuclear energy a source of low-cost electricity. Gates says TerraPower's plant is on track to start producing power by 2030. And the season's first heat wave stretching from the Great Lakes to the Atlantic Ocean is set to raise electricity demand and slow transportation networks. Here in Manhattan, we're set to reach 91 Fahrenheit on Tuesday and steadily get hotter through the week, with humidity making it feel closer to 100 degrees, according to the National Weather Service, which also said some areas could experience the longest heat wave they've seen in decades. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, is this a Liz Truss moment?
Drawing comparisons between what could happen in France versus the mini-budget crisis in the UK in 2022. Is anyone proposing some degree of fiscal consolidation right now? And it doesn't sound like it.
So basically someone in the control room is trolling me. But that's coming up next. You're watching Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Coming into a new week, really kind of more abound when it comes to where markets are. It's been anything but, though, last week, really climbing to record high after record high, but on a fewer and fewer cohort of names, all tied to the AI trend. What we're seeing right now, pulling back just a touch from the 5,500 mark on the S&P at the same time that you have the likes of Evercore ISI looking for 6,000 at year-end. Euro gaining just a touch, basically wavering here around 107. 10-year yields up just marginally about a basis point to 423, and the crude levels you can see just lower by a touch. I want to watch this, though, Anne-Marie, given the fact that we're seeing that increased demand due to the heat wave.
Yes, and also Amos Hochstein overnight talking to the FT, talking about the fact that they will step in if they see gasoline prices go higher, alluding to the fact that they could tap the SPR again. Election Strategic Petroleum Reserve, as Jonathan would say.
All right, well, we can talk about that extensively right now. Under surveillance this morning, the moment we've all been waiting for. Is this a Liz Truss moment?
It doesn't really matter in terms of if it's a left coalition or right coalition. The fiscal policies are worrying. Drawing comparisons between what could happen in France versus the mini budget crisis in the UK in 2022. I've heard a lot of questions from clients about that as well. Those are the scenarios that people are talking about. So beyond the headlines, let's have a look at the policies. Is anyone proposing some degree of fiscal consolidation right now? And it doesn't sound like it.
Here's the latest. The euro coming off 6-week lows ahead of snap elections in France later this month. Far-right leader Marine Le Pen making an appeal to moderates and investors, saying she won't try to push out President Emmanuel Macron. Instead, it'll be cohabitation. Polls showing her party holding a lead with 35% of the vote, with Macron's party polling third at 19%. Joining us now is Elsa Linos of RBC. Elsa, do you think that the risks are sufficiently priced in of potentially Euro anxiety, the idea that there could be some sort of shift away from the collective region by a major economy, namely France?
It depends which market you look at, to be perfectly honest, because the spot market has barely budged. Yes, euro is a little bit lower, as you mentioned, but that's really euro dollar. If you look at euro yen, still very much near the highs. Euro Swiss has had a decent move, but only really back to levels where we were in February. The vol market's been pretty different. You know, I think tail end of last week, you saw a lot of interest from investors to buy some euro vol, to put on some downside structures. But even that, you know, Monday, given the news over the weekend and Marine Le Pen saying she'd work with Macron, not looking to push him out, investors are already fading those moves. So to answer your initial question, is it priced in? No, clearly the worst case scenarios are not priced in at the moment.
Potentially, though, we could see a hung parliament. In that case, Elsa, do we just go sideways in terms of euro trading?
It's very possible, and I think, frankly, that's why people are struggling to pile into short euro-dollar positions at the moment. The fact is that we have seen cohabitation before in France. You know, we haven't seen it in this kind of setup, whether it's the far right or the far left that wins. Both have fiscal policies that are pretty extreme in some cases. But the reality is that we've been here before in the euro area, and every time you kind of investors sense there may be some crisis down the corner. We saw it with the elections in Italy when Meloni won. It doesn't ever really pan out, and I think that makes people nervous about putting on positions, having seen it not work so many times before.
Well, Elsa, if that's the case, and it's unlikely to be anything disastrous when it comes to a deficit. Let me put this idea to you, that what we're seeing from the market is they are simply trying to test the ECB. They want to see if the ECB comes in and cap spreads like they did when Maloney was elected. Is that what it is? Bond vigilantes pressing Christine Lagarde and co.?
Yes, it's definitely true that you've seen more of a reaction in the fixed income market than you have in the FX market. And part of that is, to your point, markets pushing the ECB to see where's their limit. I mean, the fact is we heard from ECB officials over the weekend, this is a repricing. And to some extent, they're quite comfortable with investors repricing a higher risk premium for France because that is part of the market mechanism. Now, if it looks like it's getting out of control and, it feels like the market is getting dysfunctional, then you may expect the ECB to step in. But otherwise, I think the ECB are going to be quite reluctant to rush to the rescue.
But what if it starts to seep into Italy, to Spain, to other countries where we start to worry about fragmentation, where we worry about their deficit levels? Could the ECB then act?
Absolutely, but that's not really what we're seeing at the moment. I mean, in fact, a lot of the observations people were making on Friday was precisely around the fact that France was trading through certain other countries. When France is trading through Spain or Italy or so on, that in itself tells you something. It tells you that people have reassessed how they're perceiving the risk of French fiscal side. And it's not so much about France exiting the EU. I don't think anybody, that's obviously a terrorist that people have in the back of their minds. But this is far more about the fiscal agenda and what's going to be the policy in terms of fiscal outlook.
Elsa, what I find fascinating about your recent research is you kind of get the sense from you that maybe you think the dollar should be stronger than where it is. That all things being equal, given the uncertainty in Europe and given what we're seeing, which is a pretty resilient economy in the US, the AI tailwind, the idea that people are taking weight loss drugs and getting new clothes and spurring a new boom there, whatever case, you should see kind of dollar preeminence. Why do you think we're not seeing an even stronger dollar? What do you think that suggests about where people's minds are at?
To some extent, you can see that bias in our forecast, but frankly, I've had 106 as a kind of low for this year. I haven't changed it. I still feel quite comfortable with that number, which is not a long way from where we are today. And 108 to the other side, it's really very much a range trade. Part of the reason I think people are reluctant to pile into long dollar positions is because there are some questions out there around the strength of the US economy. It's not our view, but there are some people out there who are saying, we're seeing some cracks begin to emerge. And if the US were to hit recession, I do think euro-dollar would be quite a lot higher. And it's that uncertainty on both sides, political risk on the one side, uncertainty around the strength of the economic data on the other, and the fact that we've already priced in a very good US economic outlook. And so, the risks on the economic side, at least, are to the downside for the US.
When it comes to the dollar, investors are still split on what a Trump presidency would mean to the dollar. Why?
It's a great question. I think in part because Trump himself is so ambiguous on what his policies would be if he were elected. You can expect that he would make a lot of noise around the Fed, push the Fed to be a lot more dovish, but I personally question to what extent he could really force the hand of the Fed. He can't nominate a president or a chair, for a couple of years. And on the flip side, there's a lot of talk around America First, around tariffs, around how much more aggressive tariffs could be in a second Trump presidency. And that leads people to think the dollar would strengthen, other currencies would weaken. So you can see how on both sides there is, a push and a pull. Where I do think markets are perhaps overly worried and maybe need to tone it back a bit is the long-term deficit outlook. Yes, it's something we need to watch, but from the dollar perspective, as long as the US private sector is running a surplus, that's much less of a currency story than some people make it out to be.
Elsa Linos of RBC Capital, thank you. So it sounds like, Danny, she's not completely on the Liz Truss moment side if it doesn't seem like she's, climbing into the deficit camp.
True. I still really like this argument. I'm going to be honest, Robin Brooks put it forward that what we are seeing is not a market that thinks it's going to be a Liz Truss moment, but wants to test the ECB. That the ECB let the cat out of the bag in 2022 when they stepped in for Italy's election and helped to cap yields. But then you get to this uncomfortable space where if they do that, then are they interfering in politics? Are they making a Le Pen government more palatable?
So a Christine Lagarde moment. We can get there. Coming up, for Citigroup's Stuart Kaiser, Bloomberg's Wendy Benjaminson, and Enda Curran, as well as Kelsey Barrow of JP Morgan on a day that we are leading into a week of Fed speak. It is full-on Fed speak week. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Chasing, right? They're chasing those winners and continuing to feed into it.
I think the haven trades are places where earnings are happening. Tech companies.
You have to be there. This is a story, and while these stocks have been great, they're still not ridiculously priced.
Equities are closer near term to being fully valued.
It does seem like there's a little bit of caution around just how much markets could be priced to perfection.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Caution, but still upgrading forecasts for year-end. Good morning. This is Bloomberg Surveillance. Anne-Marie is back in the hot seat. John Farrow off, but Danny Berger, we're very glad to say, here for all 3 hours and throughout this week. Right now, we are coming into a week after 4 straight record highs on the S&P, on the NASDAQ, led by a small cohort of stocks. And this morning, Danny, coming in to a number of upgrades from a lot of shops that say, hey, listen, just because it's narrow leadership doesn't mean it's going to end.
Exactly. From Goldman Sachs, from Citi, from Evercore dark horse, I think, is interesting because Julian Emanuel is essentially arguing this is just the first inning of an AI boom. But that basically argues that you're going to have to see more cooperation from different non-traditionally tech companies. Is that really the case? Is the AI boom going to spread more widely to different industries?
Which raises this question, what could potentially shatter the confidence that people have that NVIDIA can keep cashing in with the leather jacket and the godfather of AI, as we hear from Dan Ives? Or is this really going to be something that's fragile, especially in light of some of the risks coming down the pike? How vulnerable do people feel, Emery, when you were over in the southern Italy eating great food and soaking up the sun?
Vulnerable about politics, not so much vulnerable about southern Italy and all the hospitality it has to offer.
All right, okay.
But when
I heard
you
this all
look
last
at
week.
actually people raising their S&P 500 targets, where else are they left to go? Remember that whole idea of, well, we're going to look at Europe? Europe's kind of a mess right now. The European parliamentary election showed that. The UK is on set for an election, and Macron is set for an absolute bruising upcoming. Sure, maybe Marine Le Pen talking about cohabitation is starting to quell some of the French markets, but there is serious concern in what Europe is going to look like.
Okay, you just wanted to get cohabitation in, because basically we've been talking about it throughout the morning.
I want it to be the lead of your note, so I'm trying to sum it up.
Just keep going, cohabitation, because that is what Emmanuel Macron and Marine Le Pen is. It is evidently a formal term in France about the party of the president and the ruling underbelly not being of the same party. It does not reference anything else. Danny, this does go, though, to this question of American exceptionalism and how much is it just simply that there is no other better place?
This is what I'm trying to make work. It's not American exceptionalism. It's Europe exasperationalism. I don't think it's a word, but I'm going to attempt to make it work. But yeah, there's nowhere else. You look at the China data. That's not great either this morning. You have to reside within the U.S. But at what point are we not saying anymore, Lisa, it's residing within the U.S.? It's just AI. That's the exceptional trade.
And is that enough? And that's what we've kind of heard from a bunch of places. This morning, it's not quite enough, although if you look under the hood, guess what's still up? Although very small, you do see the NASDAQ with a little bit of a lift, even though the S&P is lower. When I say little bit, I mean little bit. Basically, the S&P hovering just a notch away from 5,500. You could see euro gaining just a touch versus the dollar after a real bruising week last week, 107.12. Remember, we were well through 108, and we have come down dramatically in the face of some of the uncertainty in France. The 10-year yields just taking back some of the gains that they saw last week. We saw a huge rally. Now we're seeing 424 if you round it up a percent on the 10-year, and crude just lower by a blip, but basically flat, $78.44. This is what we'll have on deck ahead of a slew of Fed speak, as well as a 20-year Treasury auction later this week. Coming up, Citigroup's Stuart Kaiser, and whether the U.S. equity winning streak continues, Bloomberg's Enda Curran as China's housing slump deepens, and J.P. Morgan's Kelsey Barrow as Minneapolis Fed President Neil Kashkari urges patience on rate cuts. We begin with our top story. Futures on pause as traders kick off a holiday-shortened week. The team over at Citi raising U.S. equities to overweight from neutral. Stuart Kaiser of Citi keeping a cautious approach, writing this: at this point, a broadening trade seems limited to a soft landing scenario. What has worked better are larger cap and safe stocks that have equity beta but less exposure to recession and refinancing risks. Stuart joins us now. Stuart, great to see you.
Morning.
Happy Monday. How vulnerable is this market, given how narrow this leadership has gotten?
It's funny because a couple weeks ago it felt really, really vulnerable, right? You know, pre-payrolls, I think people were talking about recession risks and how this could kind of derail the rally, and then a strong payrolls report, a friendly CPI, and everything is sort of hunky-dory again. So, the narrow leadership is an issue, especially because I think the market's tried to broaden out the AI theme a couple times this year, and each time it's sort of failed to some degree because there are just so few companies that can actually demonstrate revenue related to AI. So I think there is an underlying risk, just that folks have gotten so bullish about the AI theme. They've tried to apply it to other areas of the market, and I think that's the bigger risk. Obviously, with NVIDIA, just this series of huge beats to consensus, eventually that has to kind of run its course as well. But I think the bigger risk here is people trying to apply AI more broadly and then sort of getting tapped back to the middle by that.
And that's actually what I saw in a lot of notes. Lori Calvasina coming out and saying this record divergence between large caps, particularly the AI drivers, and small caps, but still stay underweight some of those small caps because there is this vulnerability. You talk about three scenarios: hard landing, higher for longer, and soft landing. How do you weigh the probabilities? What do you have to see before you start believing in a broadening once again?
Look, I think the probability is exactly right. We get a lot of questions. Is this the time to own small cap? Is underperformed by so much, by historical standards. And our point in the note was, you have to assign a reasonably high probability to this soft landing outcome to really have the confidence, I think, to buy that smaller cap stock. And if it's 10 or 20%, that's probably too low a chance. And the more you talk to clients, I think that outcome has been narrowing as the year has gone on, right? Because we just saw a slew of data, whether it was downward revisions to 1Q GDP, Chicago PMI, ISM. There's been a lot of sort of shots across the bow on weakening growth, and I think that's just made people even more and more reluctant to kind of take the step into that smaller cap.
And that's what Mike Wilson, Morgan Stanley, talks about, that weak growth that is starting to seep into the market. It's this irony that both he and Julian Emmanuel can be correct, that you can have a market that reacts to weak data and AI supporting us. But to your point of the AI trade widening out, JP Morgan's Eduardo Lucabari basically says that for equities to avoid a 20% correction, you have to believe that tech will become a much more meaningful driver of growth for the broad economy in short order. Would you go that far as to say that?
No, I don't think that's the only thing that's preventing us from a 20% drawdown. But clearly the AI theme has been applied, and it's almost turned into a macro story, right? That this is going to create higher productivity in workers, and you're going to get a GDP growth that is higher than you might have assumed. GLP-1, which we've talked about, also kind of fall in that category. So yeah, I mean, there are some big assumptions being made about not only how profitable an NVIDIA or a Microsoft or pick your AI software stock could be, but also what does this do to kind of longer term trend economic growth, and what does that do to your kind of long term view?
Do you buy that it will lead to that?
We're going to have to see. I think the challenge for me on AI, one is there's only a small number of companies that are demonstrating they're able to generate revenue. So is the flip side of your argument that we're just going to see large cost reductions, and that allows kind of a longer runway for growth related to AI? I think that remains to be seen. AI as well, companies have been using forms of AI for a while already, right? That annoying chatbot you deal with is what people are now calling AI, right? So, we're not going from zero here, and I think to some extent that does mean we're going to have to wait a little bit to see either A, the revenue demonstration, or B, confirmation of the cost reduction.
For a while, people were talking about potentially starting to broaden out and look at Europe. Now you're writing that you see a lot of risk premium being built into what's going on politically. Mm-hmm. What are you seeing in terms of European equities?
Yeah, I mean, the vol in Europe just, spiked massively last week. You're back to levels we haven't really seen since the European debt crisis in 2015. The U.S.-Europe trade is tricky from a lot of different directions. I mean, the U.S. is large cap tech and growth. Europe tends to be a little bit smaller cap, more value, more cyclicals. So you have a lot of factor risk that people are dealing with. It's funny that people in Europe are looking to the U.S. and say, hey, we wish we had that political scenario, right? I mean, that's if you're living here, that's sort of a surprising conclusion to draw. So, I do think, particularly in European banks, people tried to engage on the long side in European banks. That positioning has come out pretty quick, with what's going on in France as well. So, look, I think for Europe to work, I think the U.S. does have to broaden out, if that makes sense. You need people willing to take more risk in the U.S., buy that smaller cap value cyclical. And once you're doing that, then you start to make this relative valuation debate between the U.S. and Europe does look cheap, right? So that can kind of lead you down that path. But I think it's a gradual path, and I think people are going to be pretty cautious about following those breadcrumbs.
So do you think this is overdone?
The pullback in Europe? Hard for me to say, because I think it really depends on what happens, in France. And I think there's reasonable concerns about the fiscal outlook in France. Obviously, we have reasonable concerns about the fiscal outlook here. So if you're getting really concerned, you're seeing some German swap spreads and some of these other liquidity metrics kind of dislocate. You have this sort of latent fiscal risk under the surface that if it gets triggered becomes a major issue again. So I don't know the European market well enough to be brave enough to step in. So for now, it's we're gonna step back and look. It doesn't feel like 2015. So in that sense, it does feel like tactically we've probably priced a little too much risk. But those are famous last words. So I'm just gonna stay with large cap growth in the U.S.
On the margins, though, does this basically send more dollars back to the U.S. and basically leave you in the same place where we saw Julian Emmanuel, which is 6,000 by year end?
Well, I'm not going to make the 6,000 call, but to me, 6,000 call is you need a soft landing outcome to get there. But yeah, look, it just reinforces the idea that the U.S. is sort of the cleanest, kind of safest place to invest. And, we have really deep equity markets. So if you want a risk that looks like Europe, you can find that with U.S. stocks. If you want a risk that looks like EM, we've got some nice small cap for you. So I think a lot of people are just saying, I'm going to express those risks in the U.S. a little more directly. Yeah, I think it does help the exceptionalism narrative a bit.
What do you make of this Peter Scheer argument that Lisa was talking about this earlier, the big swings that we've seen in stocks, specifically mega caps, is a sign that liquidity is really bad in the American equity market?
It doesn't feel that way. I agree we've seen some big moves, but if you look at in the last 10 days, we went from trading recession to higher for longer to soft landing in like a 4-day period. So, is it a lack of liquidity, or is it the fact that the narrative is changing a lot and the data is unstable and people are being kind of very reactive about that uncertainty? Certainly I think the U.S. equity markets are still pretty healthy. I haven't looked at the data he's looked at, obviously, but no, I think it's summer, things have quieted down a bit, but I just think the incoming data has been unstable enough that has kind of reflected itself in the instability of the markets themselves.
Before we let you go, let's talk about weight loss considerably. That you said GLP-1, and I thought there was a fascinating story over the weekend. The Wall Street Journal talking about how a lot of retailers are seeing a real increase in shopping from people who are using some of these weight loss drugs, in particular for tight-fitting clothes, and they've changed some of their looks. How much could that be a broadening out kind of trend? We've been talking about this and that this is sort of the new AI. At what point do you see that?
It's a great question. I mean, the bigger discussion we've had about GLP-1 is sort of labor force participation and things of that nature. So it's possible. You get a job, you have to buy more clothes. I thought those drugs made you really depressed too, though. So I'm not exactly sure what people are shopping for.
Stuart Kaiser on GLP-1s, Citigroup. Thank you so much for being with us. Looking forward to the next time. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. European markets continuing their volatile streak amid uncertainty in France. This coming as Citigroup strategists downgraded the region from overweight to neutral, citing the risks from a potential far-right majority in France, as you were discussing, in the upcoming parliamentary elections. But French far-right leader Marine Le Pen did soothe markets earlier, telling a French newspaper she'll work with current President Emmanuel Macron if her party wins the elections. The number of voters here in the U.S. who say they don't like either major party presidential candidate is at a historic high, according to the Pew Research Center. The amount of double haters, as they're called, make up 1/4 of the electorate. That's nearly twice as many as this point back in 2020. Double haters were a key factor in Donald Trump's upset win in 2016 when they broke for the Republican candidate over Democrat Hillary Clinton. The biggest threat to Biden and Trump is that voters will stay home or vote for an independent candidate like Robert F. Kennedy Jr. And for the first time ever, a Deadpool movie will open in both China and the U.S. simultaneously. Disney has announced that Deadpool and Wolverine will be released on July 26th in mainland China with, quote, minimal cuts. Previous Deadpool films saw no release to months-long delayed releases as the R-rated movies face scrutiny and censorship from China's Film Bureau. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, inflation in the crosshairs for President Biden.
Over the last roughly 3 years, there's been a significant increase in the price level. So it's something the Biden administration absolutely wants to address.
That's coming up next. This is Bloomberg.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Coming into a week without an incredible amount of price action. Last week, though, was anything but, with a massive rally in the bond market. And what you saw was 4 record highs on the S&P 500, just kissing that 5,500 mark on the S&P, down less than a percentage point, with less than 5 basis points. What you can see is the euro just a touch stronger after a real bruising week last week, 107.11, and 10-year yields up just marginally, but really not that significantly considering the huge rally that we saw last week. Under surveillance this morning, inflation in the crosshairs for President Biden.
Over the last roughly 3 years, there's been a significant increase in the price level. It's now rising at a very slow, close to normal rate. But yes, Americans see that, and mainly it comes on top of concern about costs that were making life very difficult. So it's something the Biden administration absolutely wants to address.
Here's the latest. The Biden administration ready to respond by tapping the Strategic Petroleum Reserve. In an interview with the Financial Times, Biden's top energy advisor, Amos Hochstein, saying the administration will do everything it can to bring down gas prices this summer as the election grows closer. Anne-Marie was talking about this earlier. Joining us now to discuss is Bloomberg's Wendy Benjaminson. Wendy, what is the threshold? Do we have any sense for the administration to take action and tap the SPR?
Good morning, Lisa. I don't know if there's actually a dollar amount threshold, but there will be the point where you'll start hearing voter complaints, or Donald Trump will start capitalizing on it, or people will get reports of people canceling summer road trips or things like that. And that's when the Biden administration might respond by releasing more from the Strategic Petroleum Reserve. But of course, that also engenders a lot of Republican pushback, which will show up in ads that he is tapping a reserve that is supposed to be there for emergencies that are not just political.
We do see, Wendy, and I know you leave our polling coverage, we do see continuously in the polls that the economy and inflation weigh on the American electorate. What does Biden need to say at this debate to try to ease some of these concerns? We heard from Janet Yellen over the weekend. I'm not sure that's doing the job.
Right. I don't think it is, Anne-Marie, although I do think there's been a slight, very subtle shift in their messaging where they are at least beginning to acknowledge out loud that prices are still too high for consumers. Because, you know, we see on the terminal, and people who follow financial news and economic news very closely will see that the rate of inflation is coming down. The Fed might lower interest rates at some point this year. But most voters only know inflation from the gas pump and the grocery store. And those prices are not as high, or much higher, excuse me, than they were when Donald Trump was president. And a lot of people just see that as an equivalent and need Biden to show that he's doing something more about it. But at least their messaging has shifted. You heard Janet Yellen say, you know, the prices were still too high for consumers. And Biden's statement celebrating the CPI last week also was, the first sentence was, prices are still too high. So I think they're beginning to shift their messaging, at least, to try to get past this.
We also saw some strong fundraising numbers from the president over the weekend. $30 million the campaign said he brought in from the star-studded event in Los Angeles. But Wendy, he's bringing in the likes of George Clooney, some of the older stars. He's struggling when it comes to the younger cadre. Why?
in a word, in 3 words, the Israel-Hamas war. I think that is really dragging down Biden's popularity with young voters. They are still very upset that the U.S. still supports Israel so fully in the execution of its campaign against Hamas and Gaza. I think there's also, although he can show that he is cogent and on top of things, he comes off as really old. He tells dad jokes. And I think that the younger voters just don't feel like he's on top of what they see as the problems in the world.
I, for one, love a dad joke, Wendy, but that's not for me to decide. It's not just the younger voters that have drifted away over Israel-Hamas. It's also the billionaire class, Wendy. You look at Steve Schwartzman, some of that ilk who have now publicly started to back Trump and fundraise for him, where they've stayed out of it before. How big of a blow is that to Biden and his campaign?
It could end up being a blow in a close race because if Donald Trump, who is having trouble raising money without people like that, because, his base are not the richest people in the country, and there is a limit to how much they can contribute. If the billionaires can now contribute to his super PACs, either paying for legal fees or campaign funding, then, that could give him a real boost while Biden can still get the establishment Hollywood money. The almost quid pro quo that Donald Trump is offering them is he is being very, very straightforward about it. If you fund me, if you get your friends to vote for me, I will work to lower taxes for corporations and the wealthiest Americans. And that is the 180 degrees the opposite of Biden's message. So, when they're looking at the bottom line, Trump may look like a better bet for them.
He also says, though, that he's going to fund it through tariffs. And there's some question as to whether that actually is feasible. Janet Yellen, we've been talking about her interview, basically saying that tariffs would have to be 100% to really make up the difference. Does the business community not care, Wendy, or are they hesitant on that sort of idea of how this actually gets done?
Honestly, I think people, the billionaire class actually feels they may be able to get to him and reason with him a little bit on some of it. He has talked about 60%, he's talked about 40%, he's talked about 100%. He's sort of all over the map on it now. And of course, this would have to pass Congress. So there's a lot of work to be done to still get to those tariffs. But the effect of those tariffs will be higher prices for American consumers, hitting hard the most Trump's electoral base.
Wendy Benjaminson, thank you so much for being with us of Bloomberg News. I have to say, this has been one of the most interesting aspects of this whole recovery, which is we don't really understand the full effects of all of the fiscal spending. This from Torsten Slok of Apollo over the weekend, saying the positive effects of fiscal policy dominate the negative effects of Federal Reserve rate hikes. And we saw that in terms of the economic data and just this, incredible line going straight up, asymptotic line, when it comes to economic growth, despite the rate hikes that we saw. Anne Marie, do you have a sense of whether there is any restraint being proposed on this fiscal spending? How much still has to be unleashed in the economy?
Well, it's an election year, so no. And whether or not it's Republican or Democrats, you're going to see spending. It's just going to be different. I was struck this morning from the Committee for Responsible Federal Budget, putting out some numbers. Trump last week was proposing potentially exempt tips from taxation. They say that would add between $150 billion to $250 billion to the federal budget deficit over 10 years. On top of that fact that potentially people are also talking about tariffs being inflationary and adding to the federal budget deficit. What does that mean for the Fed? It is why it's so hard for the Fed to predict 2025. They don't have all the information ahead of them on what actually the fiscal policy is going to look like, because it's very different, even though there's going to be more spending, but it's very different whether or not it's Republican or Democrat.
Well, part of the issue, though, is it's the trajectory we're talking about, right? It's the trajectory that we're really worried about. At its current level, perhaps it's not concerning. So you really need this forcing event. Just saying maybe sometime in the future it's going to be a problem isn't enough to get this political action. So what do you need? Maybe you need an economic event. You need Canada a la 1990s to say, okay, this is really bad and we step in. Or is it political? Is it insolvency of Social Security or Medicare? But again, these are things that are far away, and it is not action that would happen now.
It strikes me, and I'm kind of thinking aloud, but the issue is, if there is a downturn, what's the fiscal lever? Is the monetary lever of lowering rates from a relatively high, relative to the past 20 years level, enough to offset the lack of fiscal potential if the deficit becomes a potential headwind to raising more money? These are some of the questions that people have that frankly don't have answers at a time where the U.S. is the cleanest shirt in the room. You were pointing at this before, Danny. I mean, where are they going to go instead? France?
Certainly not.
The cleanest shirt in the room, but it has stains. This is the problem.
France maybe we want to cohabitate with France. I don't know, I'm not sure.
And maybe our cohabitating partner can take it to the cleaners. Coming up, disappointing data out of China. We'll be discussing that, less of the cohabitation right now in markets. Not doing much, although really you're still seeing that divergence between small caps and the mega cap techs still eking out the wins. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Coming into a new trading week after seeing a slew of record highs last week, hard to find real action this week as people look ahead to, yes, Fed speak galore, you can't get enough of it, but also some key data. And this actually is something we haven't talked enough about. The fact that we get retail sales tomorrow really is key at a time where people are trying to understand whether the weakening in economic data speaks to something deeper or just simply a normalization. NASDAQ futures, I want to pick up on this, up about 0.2%, even as the S&P is pretty much unchanged. The Russell 2000 not surprisingly, down almost 0.2%. Danny, how much are we seeing this divergence continue, frankly, in the notes that we got over the weekend with strategist after strategist saying, frankly, this isn't going to change unless some dramatic shift in the economy happens?
Again, I get back to this irony of you can have a world where Julian Emmanuel of Evercore says we're going to 6K because of AI, and you can have a Mike Wilson saying we're more sensitive to weak economic data, and both are true, because under the hood, it is a record divergence between the S&P and to equal weight. Something has changed where bad news is only bad news for the rest of the market.
And that something might have to do with the bond market. What we saw last week was a huge rally, a huge bid into the U.S. government bond market as people took a look at a softening in inflation data, a softening in broader economic data. And what you saw, even with auctions, people flooded into U.S. dollar bonds. Today, you're seeing a bit of that taken back, but still lower across the board from last week, up about a basis point for the 2-year and the 10-year, up about 3 basis points for the 30-year. I just wonder why this isn't benefiting that huge rally in the bond market. Why that isn't benefiting some of the smaller companies that sensibly were more levered to the potential of higher rates, and we're supposed to benefit from them coming down.
Well, one argument I've heard is that the small cap companies have a lot of floating rate debt, so you need something really big to come down, and so you need to see, look, the rate cuts. You need to see the whites of their eyes before you can actually trade the small caps, just because we are concerned about refinancing, and maybe if it's Neil Kashkari world and it's just one cut in December, that isn't enough to remove the maturity wall concerns.
Meanwhile, you're seeing a fluctuation in the currency space when you look at the euro versus the dollar as people reassess after the big sell-off from last week. Turn to green, a little bit stronger of a euro versus the dollar, a little bit being the operative word, 107.15. Under surveillance this morning, Minneapolis Fed President Neil Kashkari saying the central bank is in a good position to take its time before cutting rates. His comments coming ahead of a busy week of Fed speak, that is an understatement, as well as U.S. retail sales data. I just wonder how much we're seeing Fed officials really kind of speaking out of all sides of their mouths and us not seeing any kind of consensus whatsoever on the FOMC.
Maybe this is why we need to trade the data. We need to ignore the Fed because for the first time in a while, the Fed's not in cohesion. It's kind of a healthy thing, though. It's kind of nice to hear, isn't it? Some actual disagreement among FOMC members.
I was struck by also what Neil Kashkari said in that interview about primacy of the dollar. He sort of talked around this when he was asked by Margaret Brennan about the G7 coming out, tapping Russian assets, highly controversial. He said the dollar's responsibility ultimately lies with the U.S. and understanding people would view the dollar, given these types of move, that's really for them to decide. Really didn't want to weigh on the controversy and the politics surrounding what this potentially means. A lot of people say this is de-dollarization and potentially de-eurozation.
Although it speaks to a larger point that Neil Kashkari has spoken about, even on Bloomberg Surveillance, where he's talked about why he doesn't see a Liz Truss moment. At the end of the day, the dollar still is the gravitational force. And frankly, last week we saw that with a lot of questions around what would happen in France, what would happen more broadly with the swing in the elections that we saw in the Euro region. Want to shift gears a little bit. No pun intended. Shares of Tesla are rising after the EV. So good, it's bad. The EV maker was granted approval to test its advanced driver assistance system in Shanghai. This, according to a person familiar with the matter, it's the next step in rolling out the feature to Chinese drivers. This is so interesting to me, Emery, because this comes at a time where Tesla is kind of walking a tightrope, where their sales depend on China at the same time that the U.S. is blocking out EVs from China. Europe is raising tariffs on EVs from China,
including Tesla.
And it raises this question of how he plans to play this. What's this sort of giving you a sense of?
He clearly wants to get this robo-taxi to hit the ground running, no pun intended. But the problem is he has a lot of regulatory issues in the United States. Remember that trip he made? Out of the blue, it felt like that Sunday he went immediately to China, and then all of a sudden we saw potentially this regulatory approval for this. Now they're starting to actually hit the ground running, and we're starting to look like he's actually putting this robo-taxi to test, this self-driving car to test. It's going to be happening in China.
And is this almost a rhetoric campaign by China to say, look how far advanced we are on EVs. You might have new tariffs coming from Europe and coming from the US, But look at this. We're letting Elon Musk test his robo-taxis. I'm also going to do a John Farrow thing because he's out, and I did watch the European soccer over the weekend. BYD was a huge sponsor. Literally everywhere you looked, whether you're watching Germany, whether you're watching England, you see BYD plastered over something. There feels something to this. Like China is really trying to use rhetoric, winning the hearts and minds, rather than just retaliating with, I don't know, a pork tariff. Just not massive.
Want to tell you, doing a John Farrow would be calling it football. He would never call it soccer, but that was a good try.
It's a great point,
You
Lisa.
didn't mention Italy and their beat over Albania.
Okay, I didn't pull a Farrow.
but who's counting?
Yeah.
let's talk about China. Given the fact that we got some data over the weekend, China's housing slump deepening in May. Home prices and real estate investment declines gathering pace. Industrial output also disappointing. Bloomberg's Enda Curran joins us now, and I want to just start with the data that we got overnight. There was a real feeling that maybe we would get a turn, and we did marginally when it came to retail sales. How negative was this, considering the industrial production really disappointed, and the housing market, yet again, we saw that we're not seeing a floor in home prices in China?
I think that's the key takeaway, Lisa, with the data on the housing market. Like you mentioned, new house prices falling by the most since 2014, new investment the weakest since 2020, and that's despite the measures announced last month, 42-odd billion worth of money made available to mop up unsold homes, on top of measures to bring down the cost of a mortgage and other incentives to try and get the housing market rebooted. So it looks like that's not yet gaining traction. I mean, it's only 1 month, of course, but it lends itself to the idea that economists say it's not enough, more needs to be done, and the rest of the world has been looking at China's real estate sector for when it turns a corner. That data suggests it hasn't yet turned a corner. We did, as you mentioned, have better numbers on the retail sales side of things, picking up a little bit there, but still well below the pre-pandemic trend, speaking to this idea that the almighty China consumer engine that used to power global growth in the previous decade or so isn't back to where it was. And to kind of illustrate just how complex things are for China right now, the central bank held back from cutting rates despite the growth story, and that's because they're trying to keep some support under the yuan, under the currency there, and they can't really move yet until the Fed makes a first move. So overall, I'd say a pretty downbeat picture on China's economic data. It lends itself to the idea that more support is needed if the government is going to hit that all-important 5% growth target this year.
And it used to be that China's problems were the world's problems, and that any time that China was slowing down, this meant a huge problem on growth in Europe, as well as in the U.S. Increasingly, we've seen the U.S. more immunized from Chinese economic woes, Europe less so. But how much does it really matter if their economy doesn't get off the ground and continues to really struggle?
I think, yeah, broadly speaking, the growth baton has been handed to the US, Lisa, no doubt about it. You saw the World Bank upgrading their forecast last week, mostly in the back of what's happening in the US. And the US consumer has been powering the global export recovery over the past couple of years. So China is playing a diminished role. Obviously, it's very important still sector-specific. For example, the spending on infrastructure is very important for the commodities markets, commodities exporters. Look at the price of iron ore, for instance. And of course, the consumer story on the ground, even though it's subdued to its potential, or it's still off the potential that it could be hitting, it's still very important for global multinational companies who are both producing and selling and shipping to China. So yes, it's diminished in the overall global growth story, but it's still very important on a sector basis, and still very important in the bigger picture, especially when it comes to trade as well.
Yeah, AKA all the luxury goods companies need the Chinese consumer to start playing ball. And we had the PBOC today. They didn't trim their rate. Why not? Why not? If we have this data that is so weak and there are concerns that we have yet to reach the bottom, why not have a PBOC that acts?
Well, I guess two things on it. The first point is, does China really need lower shorter-term interest rates? I mean, there's a view that money is already cheap enough in China and nobody wants to borrow, so you have to get the animal spirits revved up in the first place. That's a domestic China story. But Danny, to your point, it's also the external story, and a lot of that comes back to Washington, D.C. There's a lot of pressure on the yuan, and there's a view that China doesn't want to cut rates in case it weakens the yuan further and puts pressure on, those wanting to get money out of the economy. There's a view that they're waiting for the Fed to move first. And as you all know better than I, the Fed story, they're still on pause. They may or may not move over the coming months ahead. But it's an example of how the PBOC is locked into the dollar and the Fed story. They're reluctant to move now for fear of weakening the yuan further. They want to hold off and see what the Fed is doing and look for that window to bring down rates at the time when they can.
And this morning we saw China launch their anti-dumping probe about pork imports going into China. Do you think this is a fresh, new iteration of a trade war between the European Union and China?
I think, so there's the economics of it and the politics of it, Anne-Marie. The economics of it, probably less significant. I mean, yes, China is Europe's biggest export market for pork, but it's a fraction of overall trade. I think it's worth less than $2 billion overall. And that, by the way, those volumes have been in decline. And on the China side of things, it won't necessarily do much for China's pork import market either. It won't necessarily stoke inflation per se, given it's a small part of the overall bucket. So the economics less significant. But yeah, to your point, I think politically it is significant. It's an example of China saying, look, we're not going to take these measures lying down. We have some tools ourselves. We can respond as we want to. Obviously, this is in response to, or it looks as though it's in response to the EU probe into industrial subsidies and the tariffs on EVs. The trick for China, though, is they've been trying to court Europe. Remember that visit by President Xi to France only a month or so ago? They don't want to be seen as necessarily overly harsh on Europe. They want to maintain those business links. They're trying to court both Berlin and Paris. They can be seen as going harsher on the US, but they don't want to lose the allegiance that they have in building there, and especially with the business community in Europe. So I think that's the tricky part for China in all of this. They want to be seen to respond, but they don't want to be necessarily isolating themselves from Europe either, because they need Europe given the tensions that are ongoing between China and the US right now.
Our own Enda Curran, thank you so much for taking the time and giving us some insight here. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The season's first heat wave stretching from the Great Lakes to the Atlantic Ocean is set to raise electricity demand and slow transportation networks. Manhattan is set to reach 91 Fahrenheit on Tuesday and steadily get hotter through the week, with humidity making it feel closer to 100 degrees, according to the National Weather Service. And as you were discussing, China has launched an anti-dumping probe on pork imports from the EU. It's the latest in escalating trade tensions between Beijing and Brussels. China is the EU's biggest overseas market for pork, although exports have fallen off in recent years due to domestic oversupply and low prices. The probe is seen as Beijing's counter to similar investigations being conducted by the EU, which is looking at Chinese subsidies across a range of industries and will impose tariffs on electric cars coming from China starting in July. And Bryson DeChambeau taking home a second U.S. Open trophy over the weekend, holding off Rory McIlroy by one stroke. In a wild final hour of golf that saw brilliance and some blunders, McIlroy bogeyed 3 of his final 4 holes, while DeChambeau sealed his win, hitting an incredible 55-yard bunker shot on the last hole and making his 4-foot par putt to take the title. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, investors bracing for loud week of Fed speak this week.
What my view would be is I'd like to see a few more months of inflation reports that are positive in the sense of similar to what we got last month. I'd like to see that continue.
That's coming up next. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software.
So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Coming into a new week without a lot of action in markets, coming off a week of record highs. Although interesting last week, the S&P was up 1.6%. The NASDAQ composite was up double that, 3.2%. And that really speaks to the divergence that we continue to see this morning in equities. Under surveillance this morning, investors bracing for a very loud week of Fed speak.
What my view would be is I'd like to see a few more months of inflation reports that are positive in the sense of similar to what we got last month. I'd like to see that continue.
So we're in a strong position, but if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
Here's the latest. The Fed's Williams, Harker, and Cook all set to speak just today. Tomorrow we'll get retail sales. And Thursday, another round of jobless claims. In the meantime, a number of other Fed speakers will deliver some utterances. Kelsey Barrow of JP Morgan writing this. The belief remains that inflation and labor market data will support rate cuts later this year, enhancing fixed income flows and credit opportunities, with corporate fundamentals remaining robust and supporting tight credit spreads. Kelsey joins us now, and this to me has been one of the ultimate tensions. At what point do we see rate cuts with this soft landing possibility that we heard from Stuart Kaiser is getting narrower and narrower at a time where the data does seem to be weakening a bit more around the edges?
Well, I think in general, looking at this all very holistically, it's really going the way that the Fed would like it. Inflation has been improving over the last two reports, and I think that that is exactly what they wanted to see. They wanted to feel comfortable that Q1 was the aberration, not the start of a new trend. We've seen that. And then on the labor market side, you know, this was really our debate. We had our investment quarterly last week in Columbus, and the debate was, you know, what do we take from all these labor market signals? You have the magnificent strength of payrolls, and then, as I would call it, the sneaky weakness in the household unemployment data. I think the reality is probably somewhere in between. And it's actually exactly what the Fed wants. Again, we're circling back to this idea that inflation is cooling, the labor market's rebalancing. It's going to be enough for them to be able to reduce policy restriction a little bit, but, you know, nothing's falling off a cliff.
And this is something that you talked about, how the biggest debate at that quarterly meeting was this issue of the labor market weakening and whether it was sort of the beginning of something more protracted. What I noticed last week is we did see this divergence between large caps and small caps. In credit markets, you saw spreads widen materially in high-yield bonds in particular, which was interesting given the rally into duration. Putting aside the increased in creditworthiness of some of these companies and some of the refinancing that we've already seen done, does it concern you that at this point, maybe all the good is up when it comes to spreads, and that if you want to bet on credit, it's a duration play at this point?
So spreads are tight, and so I think there is a limit to how much tighter they can get. It's going to have to come from some of the lower quality names, which are what is keeping some of the yield in the index right now. But I would say, you know, the thing that I found notable was that the correlation between duration and risk is turned right way, and that's because inflation has been coming down as we anticipated. So how we build portfolios right now, How is it different from 3 months ago? Well, 3 months ago, we were leaning into credit. We still really liked investment grade and high yield, thought the corporate fundamentals were strong. I think the difference now is trying to find those hedges in portfolios, because now we're 3 months closer to the election. That's a risk. We've also seen some mixed data on the labor market side. So where can you find hedges that allow you to keep invested, keep collecting that carry? Because ultimately, in a negative yield curve environment, we do need to figure out how to build yield into portfolio, but also look at those hedges. I think the hedge that looks most attractive to us right now would be yield curve steepeners. So 2 areas where I think that works. One is if the labor market weakens unexpectedly and that household survey and that 0.6 increase in unemployment is the start of something more material, the curve is going to steepen because the Fed's going to be cutting more aggressively. On the other hand, I think the risk is election. That's a term premium story, and again, potentially good for steepeners.
So is this a steepener then, to your point, if it is concern about what the economy is doing? Is that a front-end story then? Where on the curve is that normalization happening?
So I think the normalization does need to come from the front end ultimately, and that's where you're going to get the disinversion. But one of my kind of long-standing beliefs has been that the yield curve will be inverted for longer than anyone expects. So it's been about 21 months, maybe 2 years now, where the yield curve has been inverted. That's the longest stretch on record without a recession. And to me, I think that yield curve inversion can probably persist until the Fed is really cutting in earnest.
As the November election comes more into view, when you say risk, what do you mean? What is the biggest risk?
Well, it's difficult to handicap right now, and I think that's why we call it a risk. I think there's the stimulus part of it, so the concern that there will be less focus on managing the deficit. But I also think that the tariff side and how we're going to approach foreign policy is also a really important risk. So I look back at when Trump was last president, and I look at what happened the last time we had this tariff war. And a lot of people talk about the inflation impact, but if you look back, it really wasn't inflation that was damaged by the tariffs. It was global manufacturing sentiment, and it was the growth impulse. So I think we need to also be aware it's not just a one-sided story. I don't think it's all about the risk of higher inflation. I think that there's also a risk on the growth side.
But when it comes to that fiscal impulse, do you see that changing, or is there any daylight between Biden or Trump for a fiscal policy impulse?
So I think this is where it gets tricky. And when we were building out our scenarios for our quarterly last week, I mean, you can't just have a Trump and Biden. You also have to play out the House and Senate scenarios, because I think that's really, really key. Right now, you have to, within your deficit forecast, consider the tariffs. Also consider the tax cuts. Will they be sunsetted? I don't think anyone thinks that's going to happen, but will they be extended, or will they be doubled down in a sense that it will be actually stimulatory? Because the deficit is already quite big. So there's a hurdle there for an additional fiscal impulse above and beyond the deficits that we're already running.
So before we get to November, we have to get through this week. We've got retail sales tomorrow. We've got jobless claims on Thursday. And then on Friday, we get the latest manufacturing data and services from S&P Global. What's going to be most important to understand whether we're still on track for that soft landing that keeps you in a sweet spot in credit that has seen an improvement, at least on the margins and creditworthiness?
All right, so I'm going to say something which was none of the things that you listed, which is actually claims. So I remember the last time that we were on, we were talking about the fact that the soft data has been telling us that the economy is terrible, and in reality, the hard data is what's holding up, and that's what's ultimately most important for the Fed, i.e. payrolls, i.e. CPI, PCE, and claims. So again, we saw that small tick up in claims. I don't think that 1 week really means much anymore. That's just kind of noise, but we do want to watch it every single week. And that can reflect a turning point. Maybe not this week, but that's what you want to watch.
Pause.
The
how many
hard
weeks?
data.
Okay, so how many weeks do you need before it's a trend? And what kind of increase would you need to see before suddenly you start to say, wait a second, this is something more concerning?
So this is getting a little bit in the weeds, but the way that I look at it is I actually look at the non-seasonally adjusted data, and then I look at the path relative to prior years, because there's a trend, and it's been very difficult to seasonally adjust the data in this post-COVID world. And so what I need to see is that the claims numbers are running off course relative to the path, the seasonal path for claims. So it would need to be, let's just say, more than 1 week, a number of weeks, where it is clear that we're running off the path of the seasonals.
And just real quick, the playbook, if you see that, go into long duration, move out of riskier credit?
So I think the Fed has been really clear here, which is that they will shift if the labor market data weakens. You know, that's a question that he's been asked at the press conferences, and he's been very clear that their framework is hold or cut, and then what brings forward rate cuts to be more urgent? It's downside risk to the labor market. We haven't seen that. If we see it in the hard data, not the soft data, that's what's going to get the Fed to move.
Kelsey Barrow of JP Morgan, thank you so much. Always a pleasure having you here. And it raises this interesting question, Danny, which is the Fed put. Is that essentially what people are betting on, that it will come back into play with just the whiff of weaker employment data?
Yeah, because it's the irony of asking if that happens, if the labor market weakens, do you need to get out of risk? And maybe the correct answer is no, you don't, because to the point that we're just talking about, it means that the Fed is more likely to take action, and the Fed put comes back, and you can keep buying riskier credit, and spreads can continue to grind tighter.
And unlike inflation, where it feels like they need to see several reports, to Kelsey's point, it feels like with the jobs market, if they see one bad report, potentially we can see a big shift at the Fed.
And it just depends on what that looks like, right? Especially given the fact that we said, we were talking about how Jay Powell noted that the payrolls report overstated the labor market. Coming up, we're going to be speaking with Lindsay Rosner of Goldman Sachs, Sam Stovall of CFRA, Stephen Major of HSBC, and Lydia Bussour of EY. Right now, you're seeing markets treading water after a week of record gain after record gain. This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zabe Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
We've got a broad story where the economic fundamentals look good, right? The growth story is pretty good. Inflation is coming down.
As far as what the Fed signaled, I think was a very balanced sort of a message.
We're seeing slowing in growth, but we're not really seeing such severe slowing that monetary policymakers seem like they really need to act urgently.
I don't think there's a lot of concerns necessarily about the U.S. economy going into recession.
The Fed's telling you they're going to cut rates even if the labor market stays tight. So if it weakens, they're just going to cut a lot more. There is a support network that's happening there.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Heading into a key week of economic data, kicking off tomorrow with retail sales. Today, we are left trying to understand the narrowness of the rally that we saw over the past few months and how it is getting narrower and narrower. Good morning. I am here today, so pleased to say Anne-Marie back in her seat after her tour in southern Italy. She was really excited to be back. Danny Berger here. Thank you so much for being with us. John Farrow not here. He is on his tour of duty somewhere warm and beautiful with great food. Right now, we are looking at a market that is basically trying to find direction after a week. I have to say, I really can't emphasize enough how narrow the range is and how dominated this entire rally has been, Danny. Just from an incredible rip-roaring belief in AI with its couple companies and nothing else.
It's interesting how the shades of this rally have changed, because at first we said AI, but AI plus everything. AI would be in utilities, AI would be in consumer stocks, so everything can rally off the glory. It's changed. It's changed back to maybe it just is NVIDIA is the winner. Maybe Broadcom gets a little slice of the pie, but the flavor has changed and makes it all the more vulnerable.
Which raises a question, to vulnerable to what, right? Is it politics? Does it really matter what Fed policy is to NVIDIA? NVIDIA doesn't need to borrow money. If anything, I've got a cash pile that's invested in T-bills that will only do better if the Fed remains on hold. So this raises the question, what risks? Last week, let's remind everybody again, Anne-Marie, you were in southern Italy, really enjoying yourself, and I'm sure you were very happy to come back. You did break a lot of news, and it was during a really pivotal period of political developments and political risk really coming to the fore. How much do you really hear about this as something that people thought of as just the beginning of a number of political surprises?
It was a parochial G7 in the sense that domestic politics loomed large over basically everyone there but Giorgia Meloni, the host. And it really was her show, it was her G7. Obviously, the concerns about France are starting to quell in the market because Marine Le Pen is coming out and she's talking about that I'm not here to ruin institutions. We can cohabitate with Macron. But then you look at potentially if there's, once the risk is over in Europe, we get a little bit more direction on where they're going to be, whether it's France, the United Kingdom, then it becomes the United States. And I'm looking back at the data we got on Friday from the consumer sentiment, and it feels like for the first time we're seeing that hollowing out of the middle class. This economic story that Biden potentially needs to come out and try to sell the data to the American people, because when it comes to consumer prices, they're not feeling it.
Well, and you pointed out to this aspect of the University of Michigan Consumer Sentiment Survey that I thought was probably the most interesting aspect, and I'm glad you brought it up, the fact that the middle-income consumers are feeling the same as the lower-income consumers, and how unusual this is, because usually the middle feels the middle, and then you've got the high end and the low end. Danny, how much does that speak to retail sales coming out tomorrow, and this question of how can they hold up in that?
Exactly. At some point, surely your feelings reflect how much you spend, but Jim Bianco says that it is back to politics, that the change we're seeing are middle-class Democrats who believe that Trump will be the next president, so their perception of the economy and how their future standings are going to shake out. That's what we're seeing in the Immerse survey. But Anne-Marie, that doesn't exactly point to great news for Biden either. Either people are unhappy or they've already just said, Trump's going to win.
If you translate this into market activity, it doesn't matter, because if you've got chips, you're happy, and that's basically what's been driving the market up. Today, we can see a similar type of trend, albeit in a muted fashion, with the S&P basically doing nothing, but just a touch lower, while you still have the NASDAQ inflected upward ahead of the open. Euro gaining just a bit versus the dollar after a very difficult week last week in the face of some of the news we were just talking about, with the shift to some far-right types of candidates, particularly in France in a snap election, 107.10 there. You can see yields up a little bit more now, up about 3 basis points. You've got 4.25% on the 10-year, and crude kind of bounced it around. It was lower, now up about 0.3%, $78.71 on the NYMEX. Watch this space, especially ahead of a very hot snap in terms of electricity usage. Coming up this hour, we've got Lindsay Rosner of Goldman Sachs on a path for a September Fed rate cut, Sam Stovall on CFRA on text dominance and equities, and Stephen Major of HSBC on the global macro outlook and why he sees a rip-roaring rally ahead for U.S. Treasuries. We begin with our top story. A busy week of Fed speak kicks off as investors look for clues beyond the Fed's dot plot. Lindsay Rosner of Goldman Sachs writing this, quote, paths to a September cut do exist, and there were some signs from Wednesday that more cuts may be possible. Powell said confidence 20 times. And confidence, after all, is just a feeling. Lindsay joins us now to talk about feelings, but I am curious about, what we learned from the Fed last week and whether it matters for a risk asset rally that seems to be completely independent from anything related to the Fed.
Yeah, well, it does matter. And we learned a lot last week. Back to the point that confidence is a feeling. We've heard for a couple months now that the Fed needs to feel confidence that inflation is moving in the right direction. Also, if they become unconfident in the labor market, i.e. see softness, they could go ahead and cut. What we learned last week is that if you tear apart the headline, which is the median dot went from 3 to 1, unpack that a bit, the mode, so where most of the people are hanging out on the Fed in terms of dots, that was 3, it moved to 2. That made the math shift down on the average to 1. Basically, there are a lot of ways that we could get to 2 cuts this year. And that would be probably September and December in our mind, because there really should be an air pocket around November election.
So you talk about all the importance of listening to the Fed speak. We got plenty of it this week. I mean, really, it's pretty much every day you get at least 1 to 3 Fed speakers. What do you want to hear? Who do you think is most important aside from just simply Fed Chair Jay Powell himself?
Powell is probably the most important, but it's not, as we know, his sole decision. It's going to be important to hear the different speakers out there, but more importantly than what they say is what continues to happen with the data. Remember, we had 3 really hot inflation prints, then we had a lukewarm, and this past one was cool. It was actually really cold in many ways, despite the summer heat wave we're about to embark upon. So we need to see the data continue to go in that direction. And the big thing that didn't move in the CPI that I think is important and people have been waiting for is OER. Very sticky, big part of CPI. But that moves with a lag, and it usually is a year or so of a lag from when rents start to move. So that could be happening any print now. We've got 3 prints before September. There is a case, in fact, that the Fed does go in September. But big picture, we're talking about maybe 25 or we're talking about 50. I think what you're highlighting on risk assets is really crucial. Risk assets have just cruised through this whole thing, and they ignore the volatility. That seems to us to be a bit strange. So when we look at where valuations are, we're finding spreads like everybody else, as the guest prior to me had said, valuations are on the really tight end of the range. Everything needs to go perfectly for that to continue to make sense. And last week we had a ton of news. We probably didn't need more. The US was enough. But sure enough, we got the snap election told to us that's happening in France. And we've seen a ton of volatility there in rates. So I think that needs to be a heads up to everybody in the US. You are buying assets right now at the tightest spreads they've been in a decade. There is likely to be volatility around our own election as well. It would be naive to think we don't see some of that here. So we're really looking for pockets of value if they emerge through the volatility, but we don't believe France, for example, is a contagion, but just the issue of vol, that should be contagious. Think about it in the future. Unlikely we stay at the same place.
Right, remarkable to watch a VIX dip below 12 last week amid everything that's happening. But the strength in the valuations you're talking about have been, again, those big AI plays. It's been the NVIDIA. The rest of the market, the equal weight fell last week. It was a record divergence. Why would that be the case if we're going to get a cut in September? Why would that be the case if things are slowing, not slow? Shouldn't the rest of the market be playing along?
Well, the rest of the market is trying to figure out, is this robust growth that I think we keep coming up with explanations for? Well, is it, to your point, is it AI everything? Is it actually the labor market is more productive? Oh, wait, we have this immigration number that is enhanced, not in documented, but some undocumented. Constantly looking for ways to justify what's going on with stocks. The big picture is there is a look through to everything. Bad news, just put it on the side, keep buying. And we're trying to say, take a moment. This thing that's happening in France is important for remembering. Valuations are really important. Your entry point does count. And we feel like there could be some opportunity to have a better entry point in fixed income, despite the fact that yields are high. And the big also takeaway for us last week is you don't want to be underweight bonds. Look what did really well on the back of volatility last week.
When you look at France, you keep saying, take a look at that. Look at not potentially contagion, but the volatility it sparked. But do you think it's overdone? When you look at the polling, it looks like potentially we're just going to get a hung parliament.
No, I don't think it's overdone. France, in our mind, was really trading very tight if you look at it in comparison to Germany. And that we're now at a level, a spread between the two, that makes a lot more sense. Very different economic outcomes or forecasts that we have there. So we've gotten to something that makes more sense. And it's not an egregious move. It's not a massive, massive move. But again, back to the tight spreads and the price for perfection we see across the globe. Really important to remember something like this, a little ripple in the water can actually really start to move things. And there's an asymmetry when you're buying at the tightest levels.
Looking for a better entry point is code for we expect a sell-off, right? I mean, this is basically another way of saying we're looking for declines in valuations because this just looks a little bit too perfect for us. What in particular do you think is so vulnerable right now?
Yeah, so we've been talking a lot about the impact of higher for longer. I don't think we're alone in sharing that. When you've had this higher cost of capital, you're going to see certain capital structures that don't work. And if we begin to see volatility ripple through the market, it is those capital structures that will be in the most pain. That will probably lead to some opportunity elsewhere. So for us, it's not see something that's distressed, see the crisis, want to invest there necessarily. It's if things start to trade in sympathy and i.e. widen, that's where we want to step in for things that we believe in from a fundamental perspective.
You also said you don't want to be underweight bonds, and this is duration, right?
Yes.
This to me is an interesting point. You don't see the risk, despite some of the politics of the moment, you don't see the risk in benchmark U.S. rates at a time where political risk is not just a European effect.
Totally true. And we think bonds are going to do what bonds are supposed to do. And there's been a question, I think, for the past few years, what is really the role of bonds in a portfolio? Do you actually need them? Stocks just take off. Forget about it. I'd rather just be in equities. And I want to be able to talk about it at a cocktail hour because people want to talk about NVIDIA. They don't want to talk about the 2-year. But
depends what parties.
Yeah, okay, maybe ours, maybe this cocktail party that we're having here, and it's a good one at an early morning in the hour. But you want to have bonds in your portfolio because they protect you. And I think when you look at what happened in France, look how much Germany rallied. So get a ballast in your portfolio of the safe haven quality assets. They will benefit you. And then if you see some inefficiencies begin to erupt in the spread markets, we want to step in there and add.
Lindsay Rosner of Goldman Sachs, thank you so much for being here. Great to see you. It's been too long. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. European markets are edging higher despite continuing political volatility in France. Citigroup strategists downgraded the region from overweight to neutral, citing the risks from a potential far-right majority in France in the upcoming parliamentary elections. But French far-right leader Marine Le Pen bringing calm to markets, telling a French newspaper she'll work with current President Emmanuel Macron if her party wins the elections, and that she is not calling for institutional chaos. Bill Gates saying he's ready to throw billions of dollars into a next-generation nuclear power plant project in Wyoming to meet growing U.S. electricity needs. The billionaire told CBS's Face the Nation that his energy company, TerraPower, relies on sodium cooling rather than water, which is believed to both simplify the process while also being safer and could make nuclear energy a source of low-cost electricity. Gates saying TerraPower's plant is on track to start producing power by 2030. And Pixar's Inside Out 2 is Hollywood's best debut since Barbie. The movie grossed $155 million at the box office in the US and Canada, besting Dune Part 2 as the movie with the biggest opening weekend of the year. The film also notching a record. Inside Out 2's nearly $300 million haul globally is the biggest opening weekend in history for an animated film. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. We still have to get Emery to a movie theater because she has not yet been since the pandemic. Up next, the morning calls and Sam Stovall of CFRA. That is coming up. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Coming into a week dominated by retail sales, jobless claims, as well as what we get from S&P Global on Friday, which is manufacturing and services activity data. Right now, not a lot going on. The S&P has crossed that 5,500 mark, basically unchanged. But you can see it on the NASDAQ is actually, again, an outperformance, even as small caps underperform. Right now, let's take a look at morning calls. First up, Goldman Sachs upgrading Toll Brothers to neutral with a price target of $124. The analyst expecting higher revenue and outperformance in new home sales. Next up, Bank of America raising its price target for Micron to $170 from $144. The firm expecting the chip maker to benefit from increased requirements to support artificial intelligence in personal computers and smartphones. And finally, UBS upgrading Best Buy to buy with a new price target of $106. The analysts expecting an electronics replacement cycle helped by, you got it, innovations in artificial intelligence. Sam Stovall of CFRA also looking closer at the tech trade, saying this: even though 6 sectors also advanced, the tech sector was the exclusive outperformer last week, causing one to wonder just how long can this jumbo jet keep flying on only one engine? Sam joins us now, and Sam, I have to say, this in some ways is the quote of the morning to me, given the fact that this is the ultimate existential question. Is this U.S. stock market ultimately incredibly vulnerable because of the dominance of the big tech names, or is it incredibly resilient because of them? Is it a feature or is it a bug? What do you think?
Well, Lisa, good morning. I think that it is resilient. However, I do believe that we are headed for a second decline of 5% or more in this year. Good news is, however, that based on my historical work, every one of those top 15 first quarters ended up with a gain for the entire year, even though many of them went through 2 intra-year declines of 5% or more, and those average annual increases exceeded 20%. But when I look to the S&P 500, I see it trading at a 32% premium to its average 20-year PE. I look at tech at a 68% premium, and I look at tech at a 21% premium on a relative PE basis. I do sort of wonder if we've gone too far too fast and need to reset the dials in order to maintain this longer-term upward trajectory.
So basically you're saying that you think that tech is going to pull back a bit as the rest of the index maybe just hovers around where it is now, and that's what's going to drive the index level 5% lower. Is that what I'm hearing from you?
Well, I'm saying it's going to decline by at least 5%. Actually, history would say that we're probably going to experience a mild correction. So that 4,800 level on the S&P, I don't think is out of the question at this point. I think that if we do start to see people take some profits in tech, it's not going to be just tech alone. Tech and consumer communication services are the only 2 sectors that are outperforming the S&P, since we had about 68% of the S&P 1500 sub-industries trading above both their 50 and 200-day moving averages. Today, that number is down to 38%. So while the market has been advancing, it's really being led by tech and, to a much lesser extent, communication services.
Sam, it's been a long time since we've seen a 5% more or decline in this U.S. stock market. It's been a long time since we've seen a 2% decline in this stock market. It is, as Bank of America once called it, the Pavlovian urge to continue to buy because stocks keep going up. What needs to change? Because valuations alone haven't spooked investors. So what changes that allows for that sell-off to happen?
Sure. Well, we did experience a 5.5% decline from March 28th through April 19th, and we recovered everything we lost by mid-May, which is not surprising because of the 64 declines of 5 to 10% since World War II. It took us only a month and a half to get back to break even. So that's why I typically say that you're better off not allowing your emotions to drive your portfolio decisions. But as we saw last time with the 10-year yield creeping higher, causing investors to worry about where it would end up peaking. Also, the worry about the Fed not likely to cut interest rates 3 times, as the March dot plots had indicated. Most recently, expectations were for 2, yet I found that investor ebullience was dashed by the dots this time around, with the expectation now only being at 1. So I think the question is, how long will the Fed maintain higher for longer, and does that increase the risk of recession?
You talk about in your note this frustration by the Fed, and people could have been humming the Meatloaf song, 2 out of 3 ain't bad. What are you expecting this week then from all the Fed speak? Do you expect them to be a bit more dovish, given the fact that the data potentially may mean they're going to cut before December?
Well, Neil Kashkari's comments, I think, were basically what he's been saying for a while, which is much more of a hawkish tone. Other commentary could, yes, take the other side as well, because the Fed wants to remind us that they are data dependent. At the same time, I think they want to let us know that they are independent of political pressures. Every election year since 1992, except 2012, had the Fed either raise or lower interest rates in that election year, and many times it occurred in September. So I don't think the Fed would be averse to cutting rates if they felt that the data supported it.
And you still think September remains in play. What's your biggest conviction for that?
Well, when I look to the CME forecast model, I see that we're looking at 1/3 or a 38% in a sense, indicating that we're probably going to stay at that current level. But obviously 62% are implying that we will probably see a cut in September of either 25 or 50 basis points. That moves up to 80% for the July period and even higher for for December. So I would tend to say that the chances are increasing that we do end up seeing a cut sometime this year, with possibly 2 still on the table.
Sam, a lot of people would agree with you. Last week, we saw a massive rally in U.S. government debt. I'm looking at a 21 basis point decline in 10-year yields, down to 4.22% to end the week. Why is that not igniting a rally in some aspects of the risk market that have not participated? I'm thinking of small caps in particular.
Well, I think first off, the reason that one reason why the yields have been coming down is because the prices have been going up, because interest rates look more attractive here in the U.S. than in overseas. So that's attracting foreign investors. We certainly are looking at small caps now trading at a 31% discount on a relative PE basis, mid caps at 25% discount. I think it's because investors want to wait until the Fed does actually cut rates because of the potential of a rising risk of recession, since these smaller and mid cap firms are the ones that will take it on the chin more so than large caps, should we end up having something deeper than simply a soft landing. So I think investors are playing it close to the vest at this point and focusing almost exclusively on the larger cap growth universe.
Sam Stovall of CFRA, thank you so much. And it does seem as though, Danny, the uncertainty on the macro front has just left people saying, the only certainty that I have is that people are going to keep buying NVIDIA.
And that is exactly what I do think it's such a good question, though. Okay, it is what we're seeing, but we're okay to say, all right, the animal spirits are going to be woken up so I can buy NVIDIA. Why not the rest of this market? Why can't we say there are going to be cuts and we can buy small caps? We're willing to suspend belief for the large caps. It does seem odd to me that this is the one place that we're saying we need to wait.
Especially at a time where people say, ostensibly, if you do get this adoption, it should benefit productivity across the board, to your point, but maybe not yet. Coming up next, a busy week of Fed speak, as well as some key economic data. We're looking ahead to it all with Stephen Major of HSBC and Lydia Bassour of EY. Tomorrow, retail sales. We haven't talked enough about that. We're going to be talking about that more coming up, just in terms of understanding how much ammunition some of these consumers still have. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Heading into a week of economic data led off tomorrow by retail sales. Those are the big hitters, although we are getting some coming out just momentarily, heading into that S&P futures, just hovering around that 5,500 level, not doing much. NASDAQ futures, though, with some modest gains, up about 0.1%. The Russell underperforming yet again, as has been the theme, with a record divergence, as Danny mentioned, down about 0.3%. What we're seeing right now, though, is a U.S. economy that has been generally trending lower but not weak, and we get that again with Empire Manufacturing, which we will get to in just a moment. Right now in the bond market, you can see yields just a little bit higher, grinding a bit higher as the session grows on. At session highs, 10-year yields 4.26%, 2-year yields 4.73%, and 30-year yields at 4.40. Danny, it raises a question at what point people still look at bonds as a haven trade, because what we saw last week very much still very much the place where people go for safety. And Lindsay Rosner of Goldman Sachs saying just moments ago, that's the trade that she likes.
Yeah, maybe it takes chaos, messiness, whatever you want to label it abroad, for us finally to like U.S. bonds again. There's one argument I heard that I thought was interesting, that French banks selling off last week meant that they pulled back from the U.S. repo market. So actually what we saw last week was just a dearth of liquidity. And that's why bonds moved as much as they did, because French banks that usually play a lot in this market because of political chaos there weren't. So it's just another roundabout way to saying French politics affecting U.S. bond markets.
Which is something we'll be looking at. It's certainly affecting the currency space. What we see right now is a euro trying to retrench just a little bit after last week's real damage done to its valuation in terms of weakening versus the dollar. Today, some firming up 107.12, but very much front and focus. Under surveillance this morning, Goldman Sachs and Evercore boosting their year-end outlooks for U.S. stocks. David Costin and the team at Goldman Sachs looking for 5,400 from 5,200 on the S&P 500. Here's the big call. Julian Emanuel and the team at Evercore making the leap to 6,000 from 47.50. And Anne-Marie, we see this pretty much across the board with people saying just because it's a thin rally dependent on a few names doesn't mean it's going to stop.
Doesn't matter. They think it's going to continue. What I found so interesting about the Goldman Sachs call was actually they gamed out a few other scenarios. And they said if exceptionalism persists, they're going to be closer to an Evercall core of 6,300 by year end. So it just looks like they have a number of scenarios where, for Goldman Sachs, that initial call is just the base case for how much higher we could see before year end.
I'm kind of surprised we aren't hearing more of the David Einhorn kind of argument that something is broken, that something else is happening, that only these big companies keep getting bigger because there are too many price insensitive buyers, that it's all of the machines, it's all the S&P 500 retail buyers, that it's all of the hedge funds who are just buying tech and that's it. And that something is fundamentally different this time. That means the fundamentally okay companies, the value stocks, this time won't catch up because that buying base doesn't exist for them anymore.
Well, and it also doesn't have the same kind of buyer base of the actual businesses themselves, in the same way that Google and Microsoft are the main buyers of NVIDIA chips. So it becomes sort of circular. The big keep getting bigger because they're helping each other on an ecosystem amid a technological shift. Talking about technological shifts, that's going to be on the docket as the campaigning season heats up. The Biden campaign raising more than $30 million after a star-studded fundraiser in Los Angeles over the weekend. President Biden also kicking off a $50 million ad campaign ahead of the debate with Donald Trump on June 27th. According to Axios, Trump is scheduled to meet with Speaker Johnson at Mar-a-Lago later today. Anne-Marie, fresh off your tour of Europe, heading into this debate, what are you watching in terms of tactics, in terms of trying to get some of the double haters back on stage?
That's true. The double haters, 1 in 4 voters say they don't like either candidate. This is a big problem for them, and they're trying to win them over. What you just said there, this $50 million ad blitz from the Biden camp, they're calling it character matters. This is what they're trying to tap into when it comes to the electorate, and what Terry Haynes, I think, put it really well earlier in the program. Trump and Biden, when they get on that debate stage, they both want to basically define the terms of this election and try to get one of those four to come over to their side.
Which has been the big challenge right now. And then the question is what the potential political risk is, given that we just saw it did matter over in France. I mean, how much are people actually gaming this out? A lot. How much are they actually trading on it? Danny, do you have a sense? I mean, my sense is not that much yet.
The only place I've seen it is the VIX. And I mean, this is slight. There is a slight kink around where the election is. But perhaps the only reason that's the case is because we know who the candidates are going to be, so we've priced it in a little bit earlier. Otherwise, we don't see it. And again, it's not just France. We learned this lesson with Mexico. We learned this lesson with India. And again, over the past few months, we are not prepared for elections.
We are prepared for Fed speak, and we get a lot of it. This week, comments coming from Williams, Harker, and Cook later today. There are 6 more speakers tomorrow, plus retail sales data. On Thursday, more Fed speak, plus jobless claims. Michael McKee, Bloomberg economics and policy correspondent, joining us now. It was the quiet period. Now is the very loud period for the Federal Reserve. What are you watching to really indicate where the bulk of the FOMC is at a time of incredible divergence, really?
I don't know that we get a complete view of that because they're going to be data dependent until the next meeting, which is until July 31st. We just got Empire Manufacturing today. It's down to -6, but it was -15.6, so an improvement to still contraction. And new orders were better, so maybe things... We get this mixed message from all of these data points that we're getting, and it's hard to know what the Fed's going to do. But as you say, we have a lot of economic indicators. It's retail sales that matters this week because it'll give the Fed some idea of where consumers are and whether the economy is weakening, because certainly the Atlanta Fed GDP now doesn't show any signs of weakening. But we're going to go through this on a regular basis, you know, for the next month and a half while we wait for the next Fed meeting.
Is there any expectations that retail sales might show some of the weakening, might show some of the survey data, so that some of that finally might filter through?
Well, that's an interesting question. Bloomberg Economics thinks so, but most other economists don't think so. We had a decline in the core retail sales last month, and now the forecast, the consensus forecast, is it goes up by 0.4, and the headline goes up as well. So this is even with gasoline prices going down, and because retail sales are denominated in dollars, that's a hill to climb, but the economists think they're going to do it. And we've seen reports from the various credit card banks that consumer spending has been holding up.
But when you look at retail sales, even if we do get a weak retail sales print, that's not going to be enough to move the Fed, is it?
No. The Fed is going to be looking at the inflation indicators, and they're going to be looking at the employment indicators. We've already got bond market analysts complaining about the fact they have to work on July 5th because it's going to be the jobs report. But that'll be a very important jobs report because it'll set the tone for what happens on July 31st, and then that sets us up for whether or not you get a September move.
Michael McKee, thank you so much. Really appreciate it. Stay close. I'm sure we will be speaking plenty this week amid all of that data as well as Fed speak. Right now, we want to dive into what to expect for the remainder of the year and whether the balance of risks has shifted as we do see a disinflationary tilt to more of the data, at least, in the United States. Joining us now, Stephen Major of HSBC and Lydia Bussour of EY, both with us. Lydia, I want to start with you in terms of what you make over the rally that we've seen in bonds over the last couple of weeks in particular, and what this signals about where the balance of risks is at a time when the Fed kind of had a hawkish tilt last week.
Yeah, so we've seen a softening in economic data, and I think that the narrative has been shifting towards the economy slowing more than what was, anticipated earlier this year when inflation surprised on the upside. So what we're seeing in terms of the economy is a gradual slowdown in economic activity. The Fed, last week was, somewhat, slightly more hawkish than expected. Coming out of this meeting, there is really this sense that they have lost some conviction that inflation is moving back sustainably towards the 2% target. So now when we look at, the next couple of months and the coming data that we were discussing, it's all going to be about rebuilding that confidence, seeing less that softening in sequential inflation, but also seeing some softening in the labor market for the Fed to be confident enough to start cutting interest rates.
Stephen, what did you make of last week, considering that we saw a hawkish tilt to the Fed, and you just reconfirmed in your mid-year outlook a belief in a rip-roaring rally in U.S. government bonds that could potentially take the 10-year yield to 3.5%.
Yeah, I'm quite glad we kept the bullish conviction. I mean, the news flow coming through on the back of these elections that you were talking about in the prelude to this interview, I think that really matters, and I think it kind of overwhelms the impact of the CPI and payrolls releases and the Fed speak. So I think it was yourself or Danny that spoke about chaos, and you both mentioned France and Mexico. There's a lot of commonality here. These are spread markets that have a lot of overseas or non-resident buyers behind them, and they don't respond well to volatility shocks. In this case, you've had election results that have brought the fiscal challenges back into focus, and bonds don't like that. So if you get a flight to quality, people move from French bonds to German bonds, from Mexican bonds to US bonds, and globally, it's all knocking on. And I think you've got an unwind going on of all these carry trades. So at a time of tight credit spreads and a bit of a vol shock, it's no surprise that treasuries are doing quite well.
Stephen, though, what happens when all of that meets U.S. political instability? If we do see something in November that looks like uncertainty about the results, confusion about the results, confusion about the policy, where does that money go?
Yeah, I guess at the start of the year, everyone was focused on how many elections there were going to be this year. It's taken till the halfway point, Danny, for there to be a significant shock, because I mean, the Indian result wasn't a big shock in a way, and it is a very domestic market. The reason Mexico and France matter is because they're so international. So the US election is still a long way away. And I think everyone who's watching this show knows that there's a lot of debt, and they know what the policies are of the two presumed candidates. So it's not like there's a big unknown out there. It seems to me that part of the reason the data is cooling is because the fiscal impulse is starting to fade. And I think all of us should just recognize whoever's the president in 2025 is going to have double the debt stock of 8 years ago. So whoever's there is going to be somehow restricted in what can be done in terms of future fiscal loosening. I don't think the US, by the way, is in that bad shape fiscally. I'm talking here about relative to other countries and considering the asset base. The growth of GDP has really helped. But of course, if the economy is cooling and the debt keeps going up, then you have more challenges. But I don't think the US Treasury market should be so worried about the debt.
Lydia, what about from an economist's point of view? If we do have, it doesn't matter who's in, we know what the fiscal situation is, what the debt looks like, a fiscal impulse that fades, doesn't matter. Do we need to start worrying about the deficit?
Yeah, I mean, we all can agree that, the fiscal policy is on an unsustainable trajectory. When we look at interest payments on the debt, they've risen, to 3% of GDP, which is double the pre-pandemic rate. Now, I don't think, this is threatening the outlook in the short run, but it does pose economic challenges in the long run. It pushes interest rates higher, can generate inflation, can, weigh on growth. And then more importantly, it also means that there is, more limited fiscal space in the event of a downturn.
Stephen, when you say that the U.S. doesn't look so bad, is that because relative to what is going on in the rest of the world that the U.S. doesn't look so bad? Or is it because you actually think the U.S. is okay when it comes to its fiscal trajectory?
Yeah, a combination of both. I don't know whether this is an English or American saying, but we call it the least dirty shirt. So I sort of imagine looking through my wardrobe and trying to find the cleanest, brightest white shirt to wear. It's a bit like that, in that the US debt stock as a percentage of GDP, if you look at the total debt, that's public and private sector, since the 2008 financial crisis, it's gone up, but it hasn't gone up as much as some other countries. And it's also been helped in the US by the fact that the household has delevered. On a relative basis, it looks not so bad, and on a historical basis, it's okay. And I think that part of the factor is the strength of the GDP and the tax take. Now, looking forward, the US has incredible taxing ability, but as we know, it's all a question of willingness.
And it's also a question of policy. You know, we have a new report out today talking about the fact that if Trump's proposal to exempt tips, for example, from taxation, it would be $150 billion to $250 billion added to the federal budget deficit. Is it very difficult to think about 2025 until we know, Stephen, the outcome of November? Or are you just expecting there's going to be a lot more debt added to the U.S.?
I think that's a big number you just put out there, but there's also going to be money coming in on the other side, because don't forget there's money from tariffs, for example. I mean, we just don't know what the outcome is going to be, and it all depends on whether we have a sweep or not, because I think the fiscal outlook will very much depend on whether either candidate wins with a sweep. So it's tricky, and I think in terms of probabilities. At the moment, you wouldn't go down a baseline or base case of there being fiscal irresponsibility. I think that it is a risk, it's a scenario, but it's not the baseline. And at the moment, I look at US Treasuries and I think that they're priced appropriately given where the policy rate is. If the policy rate starts coming down, yields are going to fall, and they're going to fall quite fast. That's what really matters. Bond yields don't go up because there's a lot of supply. And it seems that some people want to inject additional term premium into treasuries because of the supply. I think it's already there. You can already see it.
Lydia, do you agree?
Yeah, I mean, looking at the elections and what the implications could be for the economy, there is a lot of uncertainty surrounding the post-election landscape. When we look at the economic impact, we really focus on two key themes that will be very important. The first one is fiscal policy, but the Tax Cut and Jobs Act in particular, and the expiration of the Tax Cut and Jobs Act, that's going to be an important issue, and can represent a mini fiscal cliff. We've estimated it could shave 1 percentage point of GDP. There is also what's happening on the trade front with the potential for escalation in tariffs. We are already in an environment where inflation is still elevated. So seeing, more inflationary impulse and, potentially some hit to growth would not necessarily be a desirable environment we want to be in, especially as the Fed embark on that easing cycle.
We're talking with Stephen Major of HSBC and Lydia Bassour of EY, both of you at a time when you're talking about yields going lower in the face of disinflation, as well as the U.S. just being a haven for a lot of dollars. Lydia, at what point do lower yields boost the economy, boost the economic activity in the United States, and have a self-reinforcing cycle versus indicate some weakness that actually would be negative for the growth prospects?
Yeah, I mean, when we look at the economy today, we're looking at an economic slowdown underway. We've seen some rebalancing in the labor market, some softening in labor market indicators. We're looking at consumers being more cautious with their spending, investments also softening, and companies being more discerning with their spending and hiring because of this tighter credit condition environment, and because consumer demand has softened and consumers are more price sensitive. So in this economic environment, with signs of softening in the labor market, we're expecting to see that recalibration in monetary policy happening, towards, September. We're expecting the first rate cut in September, and rates starting to gradually move lower and move away from that restrictive policy stance. And, by, seeing that those rates moving lower, we should, ensure that the economy doesn't slow down materially. We're expecting to see growth falling below trend in the coming quarters, but we're not expecting to see a retrenchment in economic activity. And the fact that the Fed is going to embark on that easing cycle should allow for that cycle to continue and run through 2025.
Stephen, what's your view on this? Because some people would say that this economy has been a lot less sensitive to rate hikes. Why would they be so sensitive to rate cuts?
Yeah, that's a fair point. So you have to be careful with this one, because I think that people are expecting just very modest rate cuts. And in fact, that's all conditioned by what the Fed's just told us in their dot plot. So I find a bit of an echo chamber around the mainstream forecasts, because they're all basically one standard deviation from the Fed. It strikes me that it's probably true that the economy isn't that sensitive to the rate cuts, but when the rate cuts come, I think they're probably going to be more than the market's pricing in, and that's exactly the point. That cutting by 25 basis points here or there isn't going to do anything. So when the economy is really cooling, and if unemployment is going up at a faster rate than the Fed's forecast, I think that could be a kind of scenario to think about. Then rates will be cut quite hard and fast. Also, Lisa, it's not just about the US cyclical economic data. It's about the structural factors, this huge stock of debt. It's about what's happening in China and Europe, and ultimately, US rates just look out of line with everything else.
Stephen Major of HSBC, Lydia Bassour of EY, both of you, thank you so much on a week where we'll be talking a lot about the Fed and rates. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hakkas. Yahaira.
Lisa, President Joe Biden will host NATO Secretary Jens Stoltenberg today in the Oval Office. The meeting comes after G7 leaders agreed to a plan to tap frozen Russian assets to help aid Ukraine. But over the weekend, Ukrainian President Volodymyr Zelensky failed to broaden global support at a summit in Switzerland, with BRICS countries Brazil, India, China, and South Africa all declining to sign a final document of support. The number of Americans who say they don't like either major party presidential candidate is at a historic high, according to the Pew Research Center. The amount of double haters, as they're called, make up 1/4 of the electorate. That's nearly twice as many as at this point back in 2020. Double haters were a key factor in Donald Trump's upset win in 2016 when they broke for the Republican candidate over Democrat Hillary Clinton. The biggest threat to Biden and Trump is that voters will stay home or vote for an independent candidate like Robert F. Kennedy Jr. And for the first time ever, a Deadpool movie will open in both China and the U.S. simultaneously. Disney announcing that Deadpool and Wolverine will be released on July 26th in mainland China with, quote, minimal cuts. Previous Deadpool films saw either no release or months-long delays as the R-rated movies face scrutiny and censorship from China's Film Bureau. That's your Bloomberg Brief. Lisa?
Thank you so much. Up next, settling you up for the day ahead. You're watching Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Only on Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
taking a look at where markets are as we are about 35 minutes away from the open, and you can see not doing all that much right now, counting you down to the opening bell. Here is the trading diary for the week ahead. Today, the Fed's Patrick Harker, John Williams, and Lisa Cook speaking. Tuesday, retail sales, plus a host of Fed speak. Wednesday, UK CPI. Thursday, another round of jobless claims. And Friday, S&P global PMI data. Remember when that actually had a really significant impact on the market. So people who say it's not the ISMs, the ISMs, it doesn't matter, think again, because it has in the past. So for final thoughts, I know you were really key on cohabitation, but there are some other things that you're looking ahead to other than French politics. Anne-Marie, what are you focused on?
Well, I'm looking at politics stateside as well. I mean, obviously, you leave the G7. It was clouded by domestic politics and this concern. Biden comes back. It is full-on campaign mode. He went directly to a campaign in L.A., and everyone's going to be focused on the debate. I think Terry Haynes had a really good point. It's how they want to frame this election and who comes off better doing that. So I'm interested also to see what retail sales says tomorrow, because where is the consumer right now? Because after that report on Friday, when you see the middle class saying they're feeling more like the lower income class structure, that's a big problem for this campaign.
I agree. There's also this issue of if there is weakness, what can kind of happen in response to it in terms of the fiscal impulse, given the fact that there already is quite a bit of debt. What are you focused on, given the fact, Danny, that we've had a whole host of potential importance aspects this week?
I think it's how the Fed speakers react to the data that we got, because the reaction so far we've heard, again, from Kashkari, from Mester, it hasn't been that great. They don't sound like people who would have changed their dot plot had they had the data in hand. So we're going to get the data. We're going to get, as you say, the loud period. Do they change their tone? We're just hearing from Stephen Major, who said, actually, they're going to cut a lot more than this market thinks. And Lisa, that's what makes a difference. That's what makes a difference to the maturity wall into companies and to the poor small caps who can't rally along.
We'll keep talking about that. Coming up tomorrow, we have Laura Rame of FS Investments, Tony DeSpirito of BlackRock, Ian Shepherdson of Pantheon, and Greg Deco of EY, all talking amid that key question. If the Fed cuts, will they cut a lot? And just how flat on their back are consumers that have been feeling kind of rotten? This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City for our viewers worldwide, I'm Matt Miller. Futures doing a whole lot of nothing, waiting for the data. The countdown to the open starts right now. Coming up, U.S. stock bulls get even more bullish after Evercore ISI and Goldman Sachs boost year-end targets for the S&P. Traders staying cautious, though, in Europe as they digest comments for France's far-right leader Marine Le Pen. And Fed speak picks back up again this week with 8 members set to give their comments. Is the data more important? We begin with the big issue, markets taking a pause as the Fed indicates it is in wait-and-see mode.
We're in a very good position right now to take our time, get more inflation data, get more data on the economy, on the labor market before we have to make any decisions. So we're in a strong position, but if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
Joining us now is Christina Hooper, Invesco Chief Global Market Strategist. And Christina, thanks so much for coming on the program this morning. What do you think about the path and the sequence in terms of rate cuts? Is Fed guidance even as important as the data points that we're going to get?
I don't think it is at all. I mean, all we have to do is go back to December of 2021. The Fed anticipated in its dot plots that by the end of 2022, the Fed funds rate would be 90 basis points, and it was about 430 basis points. So we know the Fed can be wildly inaccurate, and so I don't pay a lot of attention to it, especially, if I think about the Fed's projection on core PCE. It has ratcheted that up from 2.4 to 2.6 to now 2.8. So that suggests to me if we get any improvement in disinflation, there should be merited more than one rate cut, because they're assuming one rate cut with no progress on disinflation. So I'm fairly positive on the outlook, and I'm not a believer in the Fed dot plot as being the be-all and the end-all for sure.
So do you see inflation slowing down maybe more than the Fed? I mean, they have to be cautious, especially after what they've gone through, right? Do you see inflation coming back down closer to 2% in the next couple of years?
I do, absolutely. Yeah. It's going to be an imperfect path. At times it's going to be ugly, but it will come down. We're removing stimulus. We're doing everything that historically has resulted in a reduction in inflation. So I think that's going to happen this time around. But there will be certainly data points that disappoint, but when we take a step back and look at the trend, I think we'll get to a place where the Fed is able to cut probably 2 times this year, in my opinion.
By the way, does your inflation outlook change depending on who wins the election in November? Are there multiple scenarios?
There are multiple scenarios, but it does not depend on the election in November. Our expectation is that monetary policy is doing a lot of the work, and what we've seen in terms of very aggressive tightening, it's taking time to work its way through the system. But that's really the large driver. That and with removal of the significant fiscal stimulus we've seen is enough to get us to a point where we're moving closer and closer to the Fed's target.
All right, I want to get over right now to Michael McKee because we're getting our latest reading on the strength of the consumer with retail sales out tomorrow. The data, as Christina says, may be more important than what the Fed actually tells us. Michael is Bloomberg's chief economics and policy correspondent. So, Mike, what data are we going to be getting?
Well, retail sales is the big one. We had the week kickoff with Empire Manufacturing, better than expected, but still negative. negative. That's not a major indicator for anyone in the markets, but it is something to trade on today. Retail sales tomorrow. The big event of the week is the consumer hanging in there. We get good news from basically the credit card reporting banks, but Bloomberg Economics thinks it's not going to be good. So you pays your money and you place your bets for tomorrow. Wednesday, get the day off. So that'll be great. Wear sunscreen. Thursday, jobless claims is going to be interesting just because we had such a rise last week that we want to see what happens. Is that a trend or is it like last year, just sort of a seasonal thing? Again, retail sales, the forecast is for things to get better. We're expecting the control group to be up 0.4 after declining last month. So this all tells you that if that comes to pass, that the Fed can stay on hold. It's not going to make a big difference. We are going to hear from the Fed, of course, as you mentioned, an awful lot of Fed speak this week as they come out of the quiet period. But does it mean a whole lot? We'll get their views on retail sales probably, but do we see any kind of change in what the outlook is? I don't think so, not this week. It's the inflation numbers and the jobs numbers that the Fed is watching. So we'll get a lot of information, but do you act on it? Going to be up to you. I did throw on the Bank of England there. They have their decision on Thursday, and after the ECB cut, and there's some thought that the Bank of England's getting closer to cutting, there'll be some debate about how that affects the U.S. economy and the Fed, but probably not much.
All right, we will talk about that for sure, how the international picture affects the U.S. economy. That's in our next block. Michael McKee, thank you very much for that. Christina Hooper, Invesco Chief Global Market Strategist, still with us, and Mike showed that there's some housing data coming out on Friday. I saw last week applications for new mortgages soared, and I'm just wondering, is this economy getting used to these interest rates? Old people like us refer to them as normal, right? But for the kids, this is not normal.
This is not normal, but life moves on. So I think for a certain cohort, they are starting to purchase. I think part of the catalyst, though, is an expectation that they'll be able to refinance in a year or two because they anticipate we're at the cusp. We're at the start of a rate cut cycle, and so that they can tolerate higher mortgage payments for a short time.
So I wonder how earnings, your view on earnings is, because we're starting to get higher and higher targets. Yesterday, Julian Emmanuel put out a target of 6,000 on the S&P. Kind of blew my mind because he was at 4,750, right? That's a little bit of a capitulation. His basis is that earnings are really accelerating this year and are going to continue to accelerate next year. I think 8% gains for this year and 5% gains for next year was his thesis. What do you see in terms of earnings?
So I would anticipate an improvement in earnings. What we saw recently was that one company was the driver of a significant portion of earnings growth for the S&P 500. So an expectation of a broadening does get us closer to his targets. And so I think that's a very possible scenario. Also, keep in mind that if we do see that start of rate cuts, if we start to see the 10-year yield come down, that gives the S&P 500 more room to run as well.
Right, so the broadening, I guess, is important, right? We're looking at a 24 price earnings for trailing earnings right now, which is historically pretty high. But if you look at just the Magnificent Seven, as they're called, they have a PE of 36 for trailing earnings. So the 493 aren't nearly as highly valued.
Absolutely. And so if they're able to contribute more, then that helps justify higher PEs. Now, I will say this also argues for investors looking abroad to make sure they have exposure to areas that have far more attractive valuations. And I think Europe and the UK are attractive destinations because they are not only attractively valued, but their cyclical exposure is higher. So if one assumes that we're going to see a reacceleration in global growth, we're going to see a reacceleration in European and UK growth, that's an attractive place to be.
Hey, do you still, I mean, I want to talk a little bit about this in the next block, so maybe we'll save that, but do you still see a broadening out in terms of regions? Because we're all worried about, you know, Le Pen winning in France, and you've seen yields go crazy over there, value wiped out from the French stock market.
Well, this is certainly a time of uncertainty and instability, but once we get greater signs that there could be stability, that when we get past this election, things look fairly smooth. I think that we'll look back and say this was probably an attractive buying opportunity. I think of this as a very short-term period, a blip. But if we look beyond this, there is a lot of potential. And I wouldn't want politics to get in the way of investing because the time horizons are so different.
Are we all being a little bit too Pollyanna-ish in terms of, worries? I heard Larry Summers say that Donald Trump is the most inflationary presidential candidate in his memory, and he's not young. Obviously, the worries about France, even though Le Pen seems to be coming back to the center and saying she's not going to spook institutions. I mean, this is really when you get great opportunities, right? When the whole world's freaking out if you don't.
Exactly, absolutely. And I think what we've seen from history is that typically when you put on political blinders as an investor, you get better performance because you're not subject. You don't get spooked, you don't move out when you shouldn't, you take advantage of opportunities. It's hard to do. You have to have intestinal fortitude. But I do think historically it has proven to be an appropriate and prudent strategy.
What do you think about portfolio construction right now? I noticed in Julian's note yesterday, he said convexity is a must, which is kind of confusing and if you're not, deep in it. But basically, he's saying like put on magnification trades, right? Really boost your bets on this AI thing, which has already run so far so fast.
Well, I think it's very important to be diversified and to look at your portfolio and ask, when have I last rebalanced? Do I have extreme overweights? And ensure adequate exposure to areas that have been overlooked for years, like small caps, where you probably are underweight just given performance in areas like technology. Now, having said all that, I do think that pursuing themes like artificial intelligence is an attractive additional component to a portfolio. And it is sensible to continue to have those exposures, but you don't want to be extremely overweight. Probably many investors' biggest overweight right now, though, is cash. Right. It's always prudent to have a reasonable allocation to cash, but many are way overboard in terms of cash exposure, and this could very well be a time to add that in.
Is it harder and harder, though, to tell your clients to be diversified? I mean, putting all your eggs in one basket has been paying off for a decade now.
It is absolutely harder and harder. But having said that, when we do go through periods where, like 2022, that is a reminder to investors that there are benefits to diversification. And of course, we are looking out on a different kind of market environment driven by changes in monetary policy, normalizing of economies and policy, and that could very well offer opportunities. We like to think of it as opportunities amidst divergence.
All right, Christina, you're going to stay with us because I want to talk more about what's going on internationally, and you have great experience there. Christina Hooper from Invesco. Joining us now, though, with a look at the stocks, individual stories moving ahead of the opening bell is Abigail Doolittle. Abby, what are you seeing?
Well, it's interesting, Matt, because we have the futures basically flat, slightly down, NASDAQ 100 up ever so slightly, but we have a lot of big names that are higher, including the shares of Autodesk. This on the news that Starboard Value has taken a roughly $500 million stake in the company. They are pushing for changes to the board, given some of the operational challenges, plus the way that they have handled the accounting probe. But that's not it. Let's take a look at some of the other big tech names in the news this morning, or on the move, I should say, starting off with the shares of Broadcom up, heading to a 7th up day in a row. Of course, they put up that quarter and that guide last week, having a lot to do with AI strength, investors liking that. Speaking of liking AI and chips, NVIDIA higher once again, vying for that spot for the world's second most valuable company. Microsoft on Friday first, Apple second, NVIDIA third, but we have Apple trading higher. And of course, Bloomberg News' John Arthur is talking about the momentum, the tremendous momentum, momentum carrying Apple higher today. But I'm not convinced it's going to keep going. We'll have to say.
Well, we're going to come back to you for a look at the charts on that for sure. Abigail Doolittle looking at some of the individual movers this morning. Coming up, we'll talk more about France. It's on everyone's tongue this morning. Marine Le Pen adding new supporters in that country.
We've been here before in the euro area, and every time you kind of investors sense there may be some crisis down the corner. We saw it with the elections in Italy when Meloni won. It doesn't ever really pan out.
More on the political upheaval in France and what it could mean for investors next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Seen cohabitation before in France. You know, we haven't seen it in this kind of setup, whether it's the far right or the far left that wins. Both have fiscal policies that are pretty extreme in some cases. But the reality is that we've been here before in the euro area, and every time you kind of investors sense there may be some crisis down the corner. We saw it with the elections in Italy when Meloni won. It doesn't ever really pan out.
All right, we're going to continue talking about what's going on in Europe. Citi has downgraded the continent from overweight to neutral. The bank strategists saying they prefer growth-oriented U.S. stocks. So just when it looked like investors were going to go back to Europe, it seems there's another boogeyman pushing them back. Marine Le Pen is that boogeyman. I think it's safe to say gaining momentum ahead of the French legislative elections, snap elections that Emmanuel Macron called after the EU election drubbing he took and other centers took. Alan Katz is Bloomberg's Paris bureau chief. He joins us now to talk about really this it seems like chaos, Alan, that Macron unleashed in the way it's been compared many times to what David Cameron did with the Brexit vote, and he lost that one. Why would Macron have done this? Isn't he worried?
Well, I certainly hope he's worried at this point if he wasn't worried in the beginning. The answer to that question about why he did that is a really tough one, and it's hard for many people to really get their heads around it. It was funny, there was an interview I was listening to on Sunday with Finance Minister Bruno Le Maire, and kept getting asked that question. And he was saying, well, this was the decision of one man, the one man who has the authority to do this. That man's Emmanuel Macron. This is one man's decision. He repeated that over and over again. And so it really is the case that this was sort of Macron decided this. He didn't really ask anyone. And as you say, he sort of unleashed this really chaotic moment in France that that most people feel didn't really have to come this way. It really feels like it was sort of as you said, it's sort of a Cameron-like, self-made moment of chaos that's happened here.
Well, and now Le Maire and others are out, I guess, promoting a new project fear, a French project fear, right, to try and get voters worried about Le Pen and the national rally. how is it going? I mean, do we know now if they're gaining momentum, if they're losing momentum, who's going to win?
So we don't know that yet. I mean, one of the things that is always true in these kinds of elections in France, that they're very complicated to tell ahead of time how things are going, because it's a two-round system. So it's very different than, say, the U.S. system, which is a one-round system. You know, you go to the polls, the Tuesday in November, and then you elect the president and Congress. Here, you go to the polls the first time on a Sunday, and then you elect essentially people for a runoff vote that then happens a week later. So it's very hard to tell. There have been some early polls, and they've shown Marine Le Pen and the national rallies, you say, being in a very strong position. Now, do they get enough to actually take control of the National Assembly, which is the House of Parliament that actually matters, that really has the power in France? It's a big step for them. It's not clear yet if they'll do it, so it's really too early to say. But there's enough of a worry that might happen that it really has caused a lot of people to frankly panic. You saw big sell-offs in stocks. You saw sell-offs in bonds last week. Things have calmed down today, but people really are quite worried about what might happen, who might take control, if anyone, and if so, as you pointed out in the run-up to this, sort of what their fiscal policies might be and what they might do were they actually to take control in France.
All right, Alan, thanks very much. Bloomberg Paris Bureau Chief Alan Katz talking to us about what's going to happen in the French elections. Christina Hooper still with us, Invesco Chief Global Market Strategist, and you truly have global perspective at Invesco, and in the past you were at Allianz and other big global investors. Does what happens in France really matter to U.S. assets? Does it matter to Americans?
Well, it is mattering, just in that we are seeing some flows into the U.S. as sort of safe haven trades because of fears around what's happening in Europe. I think it's very short term, but yes, in that way it does have an impact.
In your note that I was reading this morning, you said divergence has reemerged as a theme. And you certainly saw that before this, right, with the ECB cut and the Fed's not ready yet. Does this amplify that?
Oh, absolutely. I mean, what we're seeing happening in elections is definitely amplifying it. We might see a number of different economies moving in the same direction in terms of that pull towards the right, but it's happening in different ways and at different times over the course of, I think, will continue to evolve this year. So that adds to the divergences, but this could be very short-lived in nature. We could see that the result of the French elections winds up being something similar to a Giorgia Meloni kind of event, where we have a more centrist party, and there really wasn't cause for the kind of concerns that many investors had. We'll see, but I do think that primarily for me, the divergences are around the economy and the monetary policy reaction.
In terms of policy, you know, it used to be when I was a kid that the right wing, at least in this country, believed in free markets, right? Open border, trade, and now nobody buys that. It's all about protectionist tariffs and, you know, attracting businesses. The Biden administration has put out a ton of money to attract businesses to manufacture here in the U.S., so much so that Europe is very angry about it. Does that continue no matter who gets elected?
I suspect it will in the shorter term. I mean, what we saw in 2023 was pretty amazing. 70% of the industrial policies were created by developed economies. And in fact, if you look at the big economies, the majors, the US, the European Union, and China, they were responsible for 48% of industrial policies. That's unusual if we look at history, and I think speaks to this desire for some level of protectionism, the intersection of national security with economic interests. All kinds of things are happening. They're happening largely in developed economies, and so we're seeing some definite trends that I don't think die tomorrow, but might not last more than a few years.
All right, thank you for tempering my sensationalism a little bit. Christina, great having you on the program. Thanks so much for joining us. Christina Hooper there, Invesco Chief Global Market Strategist. Coming up, we're going to give you the morning calls, and then later Sarah Hunt of Alpine Saxon Woods joins us on tech's momentum and whether it still has room to run. This is Bloomberg.
the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Searching for direction. We're going to get a lot of Fed speak this week, so that could move these dials. But right now, S&P futures just down a little bit, partly on concern out of France, although you would expect that concern to drive assets out of Europe and into the U.S. Rather than weighing on our markets. Let's get to the morning calls right now. I'll look at some of the analyst recommendations on Wall Street this morning. First up, UBS upgrades Best Buy to a buy from a neutral, raising the price target to $106. The analyst sees higher levels of product innovation, including AI and growing sales of new categories like e-bikes and furniture, driving more shoppers to Best Buy. Next up, Citi upgrades Capri, parent company of Versace and Jimmy Choo, to a buy from a neutral with a price target of $41, citing potential upside regardless of Tapestry's deal to buy the company.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg.
This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading, looking for some direction today. The concern in Europe weighing on S&P futures right now. The Stock 600 dropping, whittling away the gains that it made earlier this morning, and that puts some pressure on S&P futures, although maybe that turns around and that money comes out of Europe and comes into the U.S. There you hear the opening bells on the New York Stock Exchange and the NASDAQ market sites. Let's take a look at some of the other assets that we're following this morning. Speaking of the move in Europe, we see the euro back down below $1.08 right now at 107.18. The U.S. 10-year yield at 4.27, 4.28, and NYMEX crude right now 0.75% at $79.05. One of the stocks that we're watching closely this morning is Autodesk, the maker of engineering software, rallying after activist investor Starboard takes a $500 million stake in the company. Joining us now to talk about that is Bloomberg's Abigail Doolittle. Abby?
So shares are rallying, but I don't think that this news is a surprise to everybody, because if you take a look at the stock on the month, it is heading to its best month since July of 2022, up about 17%. Today it's its fourth up day in a row. So again, I think that some folks had known about this, but what we're talking about is that roughly $500 million stake by Starboard Value in Autodesk, the engineering software company. They are saying that some of the company's performance metrics, not great, but they are also pushing for changes on the board. In fact, they are filing a lawsuit against the company to delay the annual shareholder meeting, saying that some accounting probe issues had been disclosed really at the last minute of when they could actually seek a change on the board. In return, we've had some comments from Autodesk recently saying Autodesk is quote unquote confident in the direction after the Starboard letter. Starboard pushing for these changes, investors liking it, thinking that things could change on the year. This is one stock that is underperforming down, but certainly today up 4%, and again in the month of June up about 16%.
All right. Abigail, thanks very much. Abby talking to us about Autodesk. Let's talk about Broadcom. It's the latest company to be caught up in the AI boom. It had an amazing week last week, and it's moving a lot this morning as well. Here's Bloomberg's Katie Greifeld with more on Avgo.
Yeah, Broadcom building on its record run here. Broadcom, of course, it supplies chips to companies such as Apple, so it has some big clients there. It surged by 23% last week. That, of course, was a record weekly performance. That's after it reported a beat and raise quarter. So let's go through just some of the numbers there. Sales in the full fiscal year, which runs through October, expected to come in at about $51 billion. Analysts had projected about $50.6 billion, so a beat there. And Broadcom, it finished Friday at an all-time high. It's up another 3.5% or so today, right now, with the AI hype cycle in full force. It's up 56% year-to-date through Friday's close. And as such as NVIDIA, Broadcom also planning a stock split, that 10-for-1 stock split. It becomes effective on July 15th, so it's going to be interesting to watch the action between now and then, Matt.
You know why the ticker is AVGO?
You know, I was hoping you would tell me.
Because, well, I think you were at Haverford at the time, that Avago bought Broadcom.
Yeah.
They said, we're going to keep our ticker, but your name.
I was not paying attention, so I appreciate that.
Katie Greifeld, thanks very much. Finally, it's been a scary few days for Monster Energy. The stock has been sliding on concerns of slowing growth in the U.S. energy drink sales market. Here with more is Bloomberg's Isabel Lee. Isabel?
Hey, Matt, shares are now kind of flat. Stifel cut their price target for the stock to 57 from 63, but it maintained its buy rating. So the new price target implies around a 20% upside from where the stock last closed. So this follows really multiple price cuts. We've seen last week MKM Roth slashing their price target to 56 from 59. This analyst there is concerned over slowing growth in energy sales in the U.S. The analyst said that if this continues to eat up the market share, then it's going to be harder to justify the multiple expansion of the stock. We also also have Jefferies also cutting its price target, but maintaining its buy rating. The company cut its target to 61 from 68. So highly caffeinated energy drinks really have seen a softening in demand in the past few months. That says consumers try to shift to more healthy options, and also as the regulators hone in on this segment. We have the UK party, for instance, last week saying that if they win the elections, they will consider banning the sale of highly caffeinated energy drinks to teenagers. So that's one thing to watch. That's in the UK, of course, but who knows if it will follow here in the US. For now, the Monster strategists are kind of bullish on the stock. We have around 17 buys, 10 holds, and just 1 sell. Monster is down now 16% year to date, though. Shares are now edging slightly higher by 0.5%, Matt.
All right, Isabel, thanks very much. Isabel Lee there talking to us about Monster and other highly caffeinated energy beverages. Joining us now is Sarah Hunt. She's a partner and chief market strategist at Alpine Saxon Woods. And Sarah, a couple of those stories were big momentum moves, not both in the tech sector, but we've seen that obviously with AI as well. So much momentum. Does that continue? Because we've had a real run-up in valuations, certainly for the Magnificent Seven, which is now looking at a PE of 36 times trailing earnings.
Well, I think what's interesting is the Broadcom news that you just mentioned, which is that you've seen a big rally in that stock. So I think that what's going to continue to happen is that people are going to latch on to different companies within the space and say, hey, wait a minute, this one hasn't moved like the rest of them. We had some Broadcom widely across the firm. So, of course, we're happy with that. But I do think that there is a risk that as these stocks get pushed higher, those earnings really have to come in to support the levels of prices.
I wonder what, last night I was reading Julian Emanuel's note, he from ISI raising his price target to 6,000 for the S&P, but really it's all about obviously AI and this space. And he says, you know, the gains from AI are going to come early in its development. Do you agree with that? I mean, it's obviously a process. We know at Apple, for example, it's going to take years for them to roll out their AI strategy, and they're just partnering up, not even using their own goods, really. But do you believe that the gains in terms of the stock market and the bond appreciation are going to come early in that development?
Well, certainly for the stocks that participate early in the development. So right now, who are you seeing rally? You're seeing the companies that have the most skin in the game in terms of sales being rocketed by the fact that people need more of these chips. They need more memory. They need certain things that go along with deploying the assets to begin with. Then you're going to have to see the development of how am I monetizing this when I'm not the company that's making the chips, or I'm not making any of the ancillary products that go into creating AI servers. And those companies now capitalize on the investments that they're making in the future. And that's why it could have a very long tail. But I also see the point of saying right now you're seeing the big gains in the companies that are in the early parts of it, because those are the companies that are getting paid right now for AI chips.
Does it matter if we get rate cuts, Sarah? I mean, in order for the bullish case to play out, do you have to have the Fed play along?
I don't think in the technology space you need to have the Fed play along, because right now there's a secular story going on in that part of technology that is encompassed in this AI situation that is different from the rest of the market. Does the rest of the market need rate cuts? I think they certainly, certain aspects and certain sectors of them do. We're going to have to see how inflation plays out. And I think the benign inflation report on Wednesday was helpful to the Fed, but it's just one after several non-benign inflation reports. So I think that for the rest of the market, yes, for Main Street, certainly a rate cut would probably be welcomed. But for the technology juggernauts right now, they're dishing off a lot of cash from all of this. I don't think that the rate story is what is important to them.
In terms of the tech sector now versus, you know, Y2K, and people are making that comparison a lot, right? Because valuations have shot up here to 20 plus over the past only 150 days, and the same thing happened previously. Is there a difference in that these companies are actually making money, Sarah? Because, you know, during the 1999-2000 boom, it seemed like driving revenue higher was the only important aspect, and there was no focus on profits.
I think that's a big differentiation, and I think that's one of the reasons that people are less worried about the valuations here as they were in that time frame. You also saw in that time frame a lot of large companies that were selling equipment, financing their own customers. And right now you have a very different situation, because the biggest buyers of some of these chips and servers are the largest companies that have a lot of cash. There's no need for companies to borrow to buy AI chips, for example. So I think it's a very different drop, and you have a much bigger, more concentrated tech picture and a much more concentrated customer base. And while there is some risk in that, it's certainly the best customer base to have right now because it's a base that has an enormous amount of cash and a willingness to spend it.
Are you talking about other businesses like B2B commerce, or do you mean consumers still have enough cash and are willing to spend it?
I think for the current AI boom in the chip space and in the server space, the companies that are buying things like Google and Meta and Amazon all have enough money to have a large CapEx program to start putting some of this stuff into place. And back in the 2000s, you had a lot of companies that were financing their own customers because the customers wanted to deploy switches and they wanted to deploy dark fiber, but they didn't necessarily have the revenues that were commensurate with their needs. And I think right now you see that. And I think on the Apple side, you've seen a little bit of consumer enthusiasm for the changes that Apple is going to bring. So I think, AI has been a part of the consumer technology world for a while. It's just the large language models that have made it much more approachable and or much more able for people to understand what's going on there. So I think that there's a willingness for people to spend on technology. There's certainly a willingness for the large tech companies to deploy capital in specs to continue to add to their capabilities. So I think that that's a little bit of a difference from the last cycle.
Right. I can understand that, companies are waiting in line to get their hands on as many chips as they can. They want to have space at server farms, et cetera. But I just wonder about the strength of the consumer. UBS, I was just saying this morning, upgraded Best Buy because they expect droves of consumers to go in, or at least online, and upgrade PCs to AI capable. We've seen this, with Dell and others. But does the U.S. consumer really have enough money to participate in this upgrade cycle? We have worked our savings down to zero, and you no longer have the stimmies that you had during the COVID period. So can we still buy as much stuff as Wall Street needs us to?
Well, I think there's been a lot of discussion about the bifurcated consumer and the fact that on the low end, you're seeing a lot more pressure. You're seeing a lot more pressure for folks that have not kept up necessarily with wage growth as everybody else has. And on the high-end consumer, you're seeing a very high propensity to spend. So I think on that technology side, and certainly the way certain things like your phones are no longer subsidized by the carriers, but at the same time, they've made payment plans. So I think that people do have an urge to get the latest and greatest, and they don't want to be left out. I think there is a propensity for that consumer to continue to spend, even though the savings isn't as strong as it was. And I think to the extent that you had a huge upgrade cycle on the PCs when we had COVID, at some point, now you're 3-4 years after that, everyone buying an extra computer because they needed one. I think there probably is some room for additional expense, especially if people think that they're going to get some hot new ability to use their technology.
Sarah, what do you think about diversification now? Bloomberg had a great story by Lou Wang a couple of days ago about the fact that, if you put all your eggs in one basket, just buy a stock tracking fund, you've trounced any kind of asset allocation fund. But it doesn't feel safe to do that. Do you go for the convexity trade? Do you look at amplification in AI specifically, or do you think diversity is still the right way to invest?
Well, I think that you always have to have a mix because in the end, yes, this has been fantastic. And if you were just looking at the Qs over a period of time, you could say, well, that's trounced everything. But that doesn't always last forever. And especially when you start to see valuations get a bit stretched, at some point, there's going to be a digestive period. Even if there isn't a big drop in the market, there's certainly going to be some sort of consolidation. And that's when you also want to have some participation in other areas. And I think right now that's been the big challenge because the economy, the data is coming in somewhat mixed. People are a little bit concerned about what's going on outside of the technology front. But the valuations in the non-technology sectors are not nearly as daunting as some of the technology valuations. So I think you absolutely have to participate in technology, but I don't think you want it to be the only thing that you have. And certainly you've now got a fixed income component to a portfolio where for a while you didn't even have that as an option.
Sarah, great getting some time with you. Thanks so much for joining us. Sarah Hunt there, Chief Market Strategist and Partner at Alpine Saxon Woods. Coming up, Bill Gates is ready to go nuclear.
Of all the climate-related work I'm doing, I'd say the one that has the most bipartisan energy behind it is actually this nuclear work.
Why he's ready to put billions more into a next-generation power plant next. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Of all the climate-related work I'm doing, I'd say the one that has the most bipartisan energy behind it is actually this nuclear work. If we unleash the innovation power of this country, we tend to lead. And I feel great about the support we're getting from the federal government in this nuclear space.
Bill Gates betting on nuclear power, plowing billions of dollars into a plant in Wyoming. His startup, TerraPower, broke ground last week for the construction of a commercial reactor in the state. Joining us now is Bloomberg Power and Renewable Energy editor Will Wade. I'm so glad to get you on the show because I was listening to you on Bloomberg Business Week with Carol Massar and Tim Stenovec. You had gone out to see a new reactor brought online. Not one of these new kind of fancy Bill Gates reactors, but like an old school one, right?
Yeah, I was down in Georgia a couple weeks ago to see the Vogtle 4 project, which finally came online. It was 7 years late. It was way over budget. It was like more than 100% over budget. And it's huge. It's, you know, it's a giant gigawatt plus reactor. This TerraPower one that Bill Gates is building is more the 300 megawatts, so it's much smaller, and it's a much different technology that they're trying to build.
But the thing that struck me is when you went to see the Vogtle reactor open in Georgia, you were like, nobody else is opening these, right? It's obviously, it's so late, it's so expensive. Who wants to get into that? Now here comes Bill Gates, and he's like, I want to get into that, not on that gigawatt level, but at a smaller level, and he wants to do many. So is it possible that this could pick up, that it could catch on?
It's possible. I mean, the thing that you need to keep in mind is it's all about climate change, because nuclear is carbon-free power that runs around the clock. Wind and solar don't run around the clock. Hydropower does, but it's hard to find places for it. Only nuclear can do that, but it is expensive and slow to build today. In the future, in theory, once we get these things going, they should be able to be built faster and quicker. But right now, it's sort of all new technology, new build, and everything that new is, slow and time consuming.
Well, and what about the waste? Is there still that problem of where to put the spent, uranium or whatever? Or have they dealt with that?
Oh, no, it's still there. Every nuclear power plant has old spent fuel rods sitting out back, and they're going to be there. But I think they're going to
be there for a while. Huh?
Well, I mean, they're going to be there for a while, and it's deadly for thousands of years. But I look at it this way: like, everything is dangerous. If you live near a coal plant, the emissions are bad. You're likely to get asthma. Gas plant, everything everything in the world is dangerous. Nuclear is also dangerous, but they take the waste issue very seriously. And there's not that much of it.
Well, okay, so if not the waste being a problem, I grew up in the wake of 3 Mile Island, as did you. Of course. We all saw Fukushima rock the markets, and they're still recovering from that. Like, can that part of it be contained? Well, with new technology, right? This is what I'm wondering, because Bill Gates is kind of a preacher in terms of nuclear can be safe. Nuclear is clean. So is he right?
Yeah, there's definitely ways that you can design new plants that they are safer. Nothing in the world is 100% safe, even if you stay in your bed all day. But the new plants, they are safer. They have a lot more advanced designs, like the ones that, if you lose the electricity, the gravity will sort of keep water flowing to keep the fuel cooled and safe. So they're not as risky as some of the old school reactors that we saw in the 70s.
This new one doesn't even use water, right? It uses like molten salt.
Molten sodium, yeah. Well, it's got liquid sodium as the coolant instead of water, so that lets it get hotter, and that makes it more efficient. Plus, it has this storage tank of salt, so you can get extra power from it if you need to.
It's such a cool science, and I'm so glad that we have you covering it, Will. Thanks so much for coming on the program. Bloomberg's Will Wade talking to us about Bill Gates' ambitions for clean nuclear power, hopefully safe as well. For some of the sector price action that we're watching in the market this morning, just 22 minutes into the session, let's get over to Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, we're looking at another small decline for the S&P 500 right now, on pace for a second down day in a row. Somewhat broad-based from a sector standpoint: real estate, communication services, utilities, healthcare, materials, tech, and discretionary all lower. Real estate down the most. Yields are popping higher today, as you know, so that of course makes those stocks look less attractive given the real estate play plus the dividends. On the upside, energy, but up just a little bit, up 0.3%, and then 3 other sectors a little bit higher as well. Let's take a look at one sector that is underperforming, however, and that is biotech. The biotech index down for a second day in a row, the worst 2 days going back for about a month or so, and it doesn't seem to be anything so macro, but there's lots of news at a micro level, including Takeda's epilepsy drug. Their phase 3 trial didn't meet the primary endpoint, and that stock and some other stocks down significantly, weighing on that biotech sector, Matt.
All right, Abigail looking at the sectors for us. Coming up, Fed officials return to the public speaking circuit. Did they ever leave? The market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Time now for the Trading Diary, what you need to be watching today and this week. We get Fed speak from Williams, Harker, and Cook later today. Tomorrow, we get U.S. retail sales, so watch EcoGo on their Bloomberg terminal. We get Eurozone and inflation data out of the Eurozone, so, pay more attention this week than you typically would, considering what we're seeing in rates and stocks over there. Wednesday is Juneteenth, so the markets will be closed. And hopefully you stay home and commemorate that in some way other than going to work. Thursday, we get the BOE rate decision. London Stock Exchange just overtook Paris as Europe's largest. So England continues to be important. This was the Countdown to the Open. I'm Matt Miller, and this is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Coming up, we're going to check in with Marcus Ashworth. He is a Bloomberg opinion columnist covering European markets. We love talking to Marcus because he does not spare his commentary. He's very frank with what he says, so this should be interesting. We're also going to check in with Kim Forrest, founder and CIO of Bouquet Capital Partners, get her market outlook. And then Jen Walentis, principal at Two Trees Management. We're going to talk about the state of commercial real estate, not just office, but just overall commercial real estate. Kind of where are we here in this post-pandemic world with higher interest rates? A lot of pain out there. We're going to see how it's faring across this country. But right now, let's kick everything off with Lisa Mateo on a Bloomberg Business Flash.
You got it in Market Drivers, brought to you by Interactive Brokers. Interactive Brokers charges USD margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. All right, we've got red on the screen. This is ahead of a pretty light week. We have the Juneteenth holiday on Wednesday. Right now, the Dow leading the losses down about 0.3%, 127 points at 38,464. The S&P 500 down 0.1%, 7 points at 5,424. And the NASDAQ, little change, down about 10 points at 17,677. The two-year yield, 4.75%. That's up 4 basis points. A 10-year yield, 4.29%, and that's up 6 basis points. On the economic calendar this week, we have retail sales tomorrow. Bloomberg Economics says autos probably led retail sales higher in May, while gasoline prices weighed on the total. If you remember, retail sales stalled back in April. Also this week, we have reports on industrial production, housing starts, and home resales. As far as earnings, a pretty light week. We have home builder Lennar reporting after the close today. Their shares down about 0.3%. We'll also hear from Lazy Boy later today as well. And we'll hear from Kroger Thursday, CarMax on Friday. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa Mateo. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. And Paul, I caught that. You almost said Wednesday.
I almost said Wednesday.
This is a tough moment for you now.
It is. Because we have off on Wednesday.
This is true.
Juneteenth,
yeah.
I'm all up for that, so that's good.
All right, so that's why we're kind of...
It's going to be a heat wave, so I'll be perfect.
Oh, yeah, it's going to be like 98 degrees. It's going to be pretty brutal. There is no real heat wave in the market, though. I got to say, I'm wondering what the next catalyst is. I know we have quadruple witching on Friday when lots of options expire. It's sort of like some are saying a liquidity event at this point. You also have an S&P 500 rebalancing. You have ETF rebalancing. So there is something to look forward to this week. In the market, though, today, not a lot happening. Vince Signorella is Bloomberg macro strategist, and he joins us now. Hey, Vince, what are you watching?
So actually, a couple of stocks very interesting this morning. Shares of Aerovite Therapeutics have fallen about 90%. Had an inhaler in the clinical trial that did meet its primary endpoint for improvement versus a placebo. So big ding for that stock. And you got to like what Disney's doing. They've been allowed to show their movie Deadpool and Wolverine into Chinese markets next month. So that's giving that stock a bit of. Also really interesting, our James Seifert wrote an incredible piece about a rebalancing in the XLK that's going to take place this coming Friday. And based on the new weightings, it looks like NVIDIA and Apple are going to be switching places. And if that absolutely happens, NVIDIA will have a huge buy signal on it to lift its weighting in the ETF, and Apple will have a big sell weighting for the same reason to reduce its weighting in the ETF. So we'll see if that turns out, but it's gotten a lot of attention, a lot of day traders on the street.
Well, you mentioned Disney. Inside Out 2 took in $295 million at the global box office over the weekend, $155 million in the U.S. And they're saying it's a record opening for an animated movie. You saw it.
I did,
All right,
yeah.
give us the review.
Oh, my God. It was so awesome. There's a new emotion. There's lots of new emotions, but there's one called anxiety. And my daughter, 9.5, was so cute, did not understand that emotion at all. Understood every other emotion. There was ennui, there was jealousy, there was nostalgia, but the anxiety could not. She was like, I don't get it. What did this do? Anyway, it was awesome.
So that's good for Disney because, one of the issues for Disney was just that maybe some of these franchises are just kind of played out, and maybe that's number one. Number two, maybe just people won't go to the theaters in size for these big summer blockbusters like they used to. But we're seeing it stock up a little bit, Vince.
Yeah, no, and actually with the heat wave coming in New York this week, might give it a boost as well, might get people into the theaters. I think, Disney's got a lot to turn around. There was, a lot of issues they were dealing with some flops of recent movies and the park situation. But we'll see. I've always been a fan.
It says, I'm just going to Bloomberg reporting, Disney and Pixar are back, and so is the summer box office. That's Sean Robbins, a film and theatrical consultant, said in a post on X. So maybe, some good news for the movie business.
Yeah, that's interesting. It's just also like what we want to see, right? I mean, Barbie, Inside Out 2.
Yeah.
Like, are those the two things? Like, this just really speaks to my world. What else are you watching, Vince?
I'm going back to the macro space, which is where I live, with retail sales coming up. That, I think, is going to be an interesting test. We've gotten some really poor numbers from the sentiment readings from UMich. There are some who are not buying what that data tells us, but that data tells us the consumer is slowing down while inflation is still picking up. So you've got that stagflation scenario, which obviously is a terrible thing for the economy and global growth. We'll see what retail sales says tomorrow. It's expected to show a boost, but down the line, we need to see where consumers are getting the money for the spending. It appears to be from borrowing. If that's the case, not great news. We need to see that spending pick up, but also with consumer incomes to pick up as well, to keep the disposable income high, to keep spending going, which is all we do to drive this economy. Go spend money.
Right. So, Vince, what's the market telling you about the Federal Reserve and where the Fed might go this year? Are we kind of 1 cuts, 2 cuts? What are we hearing these days?
I mean, the market is fighting the Fed at the moment, and that generally doesn't play out well for traders. It never played out well for me. The market's thinking well ahead. The Fed was, I think, very, very careful. Powell in his Q&A last week about staying neutral, keeping options open, not committing to a number of cuts this year. But the market's gone ahead and priced in at least 2. Some are calling for 3. I think there's a reasonable possibility to see none, depending upon how this plays out. I think to get 2 to 3 rate cuts, you really have to see the economy stumble in a big way. And that's just not going to be good for earnings. That's not going to be good for stocks either. So looking for the Fed to save you with 2 to 3 rate cuts, to me, would suggest bad news. And that's not a saving grace, I think, for the equity markets.
All right, Vince, always a pleasure. Thank you so much for joining us on This Money. Looking forward to all that rebalancing on Friday. Vince Signorella, Bloomberg macro strategist. And speaking of, the Bloomberg Dollar Index is at the highs of the year so far. Euro dollar is 107. You have, yes, the euro is a little bit stronger against the dollar, but man, it was a really tough week over the last week with the turmoil in French politics. Luckily, we have an expert with us. Marcus Ashworth is joining us. He is from Bloomberg Opinion. I haven't talked to you, Marcus, in, 10 months?
Yeah, it's been ages. Too long.
Too long. It is so good to hear your voice. Okay, we love about you is because you have opinions. What do you make of what's unfolding in France right now?
I'm such a shy, retiring type normally. What do I make of it? I mean, look, it's not a crisis yet, anyway. I think it's a problem which was 3 years out in the future in 27, whoever's going to replace Macron. He's just rolled the dice and brought it forward by 3 years. He's trying to solve probably a bigger problem now, earlier, and getting a better result, perhaps, he hopes. What it has highlighted is that there's been a long, deep-seated, ever-growing fiscal problem in France where they've hidden, essentially, been allowed to get away with it for ages and ages. First, we had a Fitch downgrade in October. We got a S&P downgrade in the end of May. And we got Moody's now having a sort of little think about really do they genuinely think France is worth a AA2? So that's because the fiscal deficit in France has risen to 5.5% of GDP, and more importantly, its debt to GDP is started rising again. There have been great hope of this downward glide path for both France and Italy. That's not happening. It didn't happen at all last year. Went quite the other way, and doesn't look like it's going to get better for at least out of this 2027 period. So no one thinks that even the current situation would have seen any fiscal improvement, with potential of a non-Macron sort of controlled prime minister and government. That means that quite the reverse is going to get even worse, and that isn't great news for France, isn't great news for the European Union. They hate political volatility. They get very spooky, particularly if a potentially Eurosceptic or, you know, pro-leaving the European Union as it once were party might get into some form of power. They get very antsy. So that's why you're best to sell or get out or stay out of France until it settles down. July 7th, we'll get the second round final results for the parliamentary elections. Macron's staying around for another 3 years.
I love the whole snap election thing. I like, because we're over here in the U.S. We're going month after month.
Oh my God,
after
years
month,
and years
just to get to November. Yes. So I kind of like this whole snap election thing here. But what's behind, Marcus? Do you think the rise of Marine Le Pen and the far right? Is it what we're seeing just around the world? Is it political? Is it economical? What's kind of really driving it?
I mean, I don't think you can call her far right. To my mind, she's a socialist. She's pretty hard left.
Okay.
And other than the fact that she's a national so-called champion, and that's what she wants to push. You know, French pension rights, French welfare rights. She's very pro-union. So in some senses, I know it's easy to label them far right, but the point here is that, you know, what clearly she's standing for is a sense of enough already from the French people on mass immigration.
Yep.
This is happening in Italy. This is definitely happening in the UK. It's happening everywhere in Europe, and I know it's happening in the US. So, look, this is a global problem. It isn't going to get solved anytime soon. But, you know, you're going to get. Look what's happening in the UK. We're getting Rishi Sunak going to get bounced out because he's failed to live up to anything he said he would do. But we're having similar across the European elections, where results tended to favour the more, should we say, anti-immigration parties. Whether some of them are left or right is a subjective point. But look, this is just bad fiscal situations getting worse, combined with you know, that awful thing that European politics really doesn't like is that fear that the European Union, the Euro project, might come under question. And that's when investors, which you believe very much in this whole France-German bedrock, and everything's been calmed down. We've got the EU issuing bonds by the gazillion in the middle, lots of pandemic programs, spraying money everywhere, and yet it isn't enough. And that's a little bit of a worry. I personally see it as a little reality check, and maybe in the long run, this might be better for Europe if they can get their act together. I don't see it as a proper Euro crisis or anything like it.
Have you noticed, or are you hearing flows coming out of Europe into the U.S. because of the political issues there? I mean, we have our own mess, but what we do have is NVIDIA.
Alex, you've got it all already. What more do you want? You can't want more of our money.
Yes, I do. I want all of your money.
Everyone in Europe is already overweight in the US. Look, I mean, I would say it's more likely to be US investors who might have been tempted to get out of the US and diversify at long last, coming up to Euro elections, may have been tempted to sort of go into Europe and have a little sniff, particularly around banks and things like that. That's why the worst performers so far have been French banks. They've been absolutely spanked. The reason why they've been spanked is because I think there's a very popular situation for US investors looking to play the old rebound there. And that, I think, is what we've seen. We've seen some fast money exit stage left. I don't think European investors are going to go anywhere. I think Japanese had already long thought very carefully about the so-called Bund Plus strategy, where you bought French bonds, you were locked in, like with Germany, you got an extra bit of yield. That works a few years ago, not so much anymore. But yeah, there may be a little bit. And so all I was saying is I just don't think any new money is going to come in until July the 7th. Why would it? It's crazy to take more risks than you need to when you've got no visibility on the outcome. There's likely to be one or two more bumps in the road before we have a clear idea. The way the French system works, you have this first round on June the 30th, and then and only then you get a clarity of who goes forward into the second round. and you can work out which personalities are going to be doing probably better or worse with more accurate polling. But that will come clearer as the days go by. I note that this afternoon, actually, France is starting to do a little bit better against Germany. French yields have actually gone nowhere in the last week and a bit. It's just that German yields have fallen hard because they're following, yes, you got it, Alex, they're following the US yields lower. It's all about the US.
See, told you.
Told you. Hey, Marcus, it was just a few weeks ago when Mr. Macron hosted a basically come back to France conference where David Solomon, Goldman Sachs was there, and Mr. Moynihan from Bank of America. I mean, is France open for business? Are people investing in
They
France?
still mark the spot. This is where Jamie Dimon stood. Now, look, we have a little competition. Funny enough, the first thing a Labour government, almost certain in the UK, are going to do is to do exactly this. Come to the UK, everything's brilliant. Come back to do business. So Macron's been very good at this, and definitely there's been some signs that not so much that the city's losing jobs, but that France is attracting more financial jobs. It's quite great tax breaks to go there. At the same time, clearly they want to promote all foreign direct investment, and arguably financial big movers, Citadel, JP Morgan, Bank of America, etc., are responding a little bit to the challenge. And one interesting thing is I think that Macron is going to relax a bit on how much that severance pay has to be in France, which is one of the big things that banks don't like, is the cost of actually losing people when they change their minds on their expansion plans. But for the moment, yeah, I think they've done a good job in France, and probably outside of London, Paris is the logical place for most financial companies and banks in particular to go. But again, they don't need this sort of publicity. It's not very good for them.
Marcus, always a pleasure. It was so good to chat with you. Definitely miss all your commentary. Marcus Ashworth of Bloomberg Opinion. I have to say, at my Father's Day dinner last night, for some reason, doing business in France came up in the conversation and about unions. And I was like, what does this mean? Like, are we at peak union? Like, what is the significance of regular people on the Upper West Side talking about this?
Yeah, I mean, again, we had that conference, in Paris, or in France a few weeks ago. And again, all the big heavyweights from Wall Street, global Wall Street were there. And it just said, basically, we're open for business. And, a lot of the big financial firms have moved some jobs out of London into Paris, in addition to other European capitals. But you just think about the taxes and some of the social programs and things like that. Is it really open for business? And can they attract significant foreign global investment into that country? So,
or is it like more open it's going to be versus other countries, right? Like the cleanest shirt and the dirty laundry.
But as Marcus was saying, now everything's on hold until July 7th to get that vote.
All right, coming up, Kim Forrest, founder and CIO of Boca Capital Partners, will give us her take on this market as S&P goes nowhere on this Monday.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Not much movement in stocks, and you have these thoughts of lingering that policymakers will be no rush to cut interest rates. You had over the weekend Fed's Neil Kashkari. He told CBS as the central bank is placed to take its time before cutting rates. So right now you have the S&P 500. Little change, down about a point right now at 5,430. The Dow down about 0.2%, 81 points at 38,508. The NASDAQ little changed, up 7 points at 17,697. The bond market, we had the 2-year yield at 4.74%. That's up 3 basis points. The yield on the 10-year 4.29%, and that's up 6 basis points. We have spot gold lower, $2,322 an ounce. Brent crude $83 a barrel. WTI crude at $79 a barrel. And moving the markets, it's software maker Autodesk. Their shares up about 4.5%. Activist investor Starboard Value, they said it's built a stake in the company valued at more than $500 million, and they plan to push for changes to its board. That is your Bloomberg Business Flash. Alex and Paul.
All right, thank you so much, Lisa Mateo. Really appreciate it. One stock that's doing some stuff is Micron. We got some price targets raised. It's going to report earnings next week, and it is just having an awesome day and an awesome ride. Let's get a take here from Kim Forrest. She is founder and CIO of Boca Capital Partners. She joins us now. Hey, Kim, Micron, what do you think about it?
I absolutely love it, but maybe not at an entry point right now. It goes up and it goes down. This is a very volatile stock, but it's certainly one to keep your eye on. And you can ask me why. Why? I have 2 letters for you, AI.
Okay, but why? Like, tell me more, tell me more.
Because of AI. This company makes the devices that build out data center memory, okay? Or, you know, where data lives. And if there's one thing I know about AI, it's that it eats data like you wouldn't believe. So if you believe in AI, you should believe in the makers of NAND and DRAM memory devices. So there you go. That's why I like it.
Hey, Kim, at a cocktail party, somebody comes up to you and says, how do I invest in AI? Where do you steer them?
Or you're at the wrong cocktail party, but yes. Go ahead.
Yes, actually, you know, I try to go incognito at cocktail parties, but that's okay. Well, I always say invest carefully and have a reasonable timeline. And I think those are the 2 things that people right now are probably forgetting by, I don't know, making NVIDIA go up by 30% since the split. Does that seem right to you? I'm thinking no, but whatever. So what you really have to look for is the chain of areas that AI touches. And again, one of them is NVIDIA, the chip that drives, you know, the models. And that's certainly important, but there's going to be a whole lot more infrastructure around it. And even things like, I know this could be a big eye roll, but telecom is probably going to have to markedly increase its capacity for wireless consumers, because we're going to be consuming a lot more data, storing a lot more data, and these models, as I say, use a ton of data. So anything in that chain is fair game right now for investing in AI.
We would never eye roll you for saying telecom. But based on the fact that you say, you know, Micron can be really volatile, you don't want to buy at these levels, you want to buy on dips, are you noticing a lack of dips? Are dips becoming less frequent at this point?
Yes, and I think it's because, you know, we're, what are we, 36 months into discovering chat, or not even that long, 18 months into discovering Chat GPT, something like that. So people are really still looking for, how do I invest in that? You can't buy OpenAI, you can buy NVIDIA, but that feels a little stretched, so where else do you look? And I say, AMD is also fair for this, because they're going to not only be a competitor for NVIDIA, but also make some of the products that go on an end device. We keep forgetting, like, the user has to be able to connect to these models. And that's really important in your search for where the outsized growth may be.
So, Kim, what is NetApp, and why do you like it other than the fact that it's up 41% year to date?
Well, I mean, that's really helpful, right? But all joshing aside, the nerdiest, I mean, it's almost like a math joke, right? Like a finance joke, but I digress. No, seriously, it's back to storage of data. Now, NetApp makes enterprise storage devices, and I think the enterprise is going to have to store a whole lot more data to make AI work for it. So that's why we really like NetApp. And just the trends in the world becoming more digitized, businesses need to have stable, safe, and reliable storage appliances, and that's what NetApp provides.
Kim, what else do you like aside from the AI trend? Like, if that's a nice trend, you got the momentum, you got to find your levels, etc. Aside from that, if I wanted to buy stuff, where would it be?
Buy stuff in tech or not in tech?
No, outside of tech.
Outside of tech. Well, I'm kind of loving, because I like to buy low and sell high. I'm looking at energy, and I like ExxonMobil because it has, just bought some land in the Permian Basin through its recent acquisition, so that's good. And I'm somebody that believes in giving yourself some margin, some room for error. And we might like EV cars, but it's unclear that automobiles and trucks are going to go away immediately. So I think the timeline for energy is much longer. And the big energy companies are also investing heavily in alternative energy as well. So we're going to always need energy. We like our things that use it.
Yeah.
So I like to invest in that as well.
Yeah, and you have the gross yield 3.5%, so you're